Including Munich. So if you're flying in and out of Germany.
Yeah. And this is the third time within just the month of February that they're dealing with this. First it was security, then it was ground strikes, now it's another set of the airport cohort.
Okay, here we go. 10 seconds to go until equity markets open. As I say, index level, probably not the story this morning. It's going to be a single stock story this morning. You're going to see a lot of individual movers. Barclays is one to watch out for, IHG as well. There we go. Markets are open. Let's get some numbers. Initial points hit. Novo Nordisk comes out a little soft. In terms of the percentage story, I want to see where Barclays opens this morning and see what's happening there. Balfour Beatty's down. Travis Perkins is a little soft as well. Glencore looks a little soft going into this as well. I wonder whether that's a nickel story translation effect.
So does Rio Tinto
as well. So the miners are down.
Yeah. The miners are down, taking with it some of the commodities as well. Looks like early indications of IHG also taking a little bit of a hit, so some weakness there, despite the earnings picture. So perhaps that momentum that you've seen not actually playing out in today's session. I'm trying to look at some of the upwards movers here. There's a little bit of a mix of everything. We're seeing some of the banks in there. Lloyd's, for example, one of your biggest index contributors. Again, I can appreciate it's only a few seconds higher at the moment, but it feels like a lot is kind of dragging this index lower.
I'm waiting to see a Barclays number, actually. I'm surprised I haven't seen that yet. So I'm just going to keep kind of pushing the numbers on my terminal.
He's manifesting a Barclays rate at the moment.
Yeah, I'm just kind of, please give me the numbers. But there's a lot to digest here this morning. So the market's got a lot to think about in terms of what is happening. The call is underway as well. We'll keep an eye on what's happening with Barclays. But banks do look a touch soft this morning. They're not down by much. I'm not seeing anything that kind of really stands out, apart from, as you say, Kriti, the basic resources sector. That is where the weakness is coming through. And as you can see, you got BHP, Antofagasta, Rio Tinto, Anglo, all softer this morning. We get Glencore tomorrow. We get Anglo as well coming through. We got Rio Tinto coming as well. But it looks like the early read coming out of Antofagasta and BHP. Antofagasta, I think, met expectations. BHP weak on the nickel side, and that's feeding through to the rest of the sector.
And it's feeding through into the broader commodity space. It's not just the miners as well. You're seeing on the stock 600 here, you're seeing Shell take a little bit of a hit here. Total, for example, is going to be one of your biggest weights as well. And somewhere buried in here is LVMH as well. Buried in the miners and the commodities is one of your biggest weights on the stock 600.
China. Look at what's happening in China. You're not seeing the pickup in China that you would have anticipated. We thought coming out of the Lunar New Year that the spend was going to be big, and we were going to see potentially some action coming through from the authorities that will be enough to lift the market. That is not happening. Air Liquide looks like it's reasonably positive as well. I need to put my glasses on to figure out exactly what is happening here. But I think the big takeaway this morning in terms of the weight is in the mining sector.
The one that's catching my eye on your one of your biggest stock 50 performers here is Relics. We actually had the Relics CEO on last week, and this is a stock that Anna Edwards educated me on, which is this is a company that is basically a legal data mine, but is being viewed by analysts as perhaps somewhere where that can capitalize on the AI move. So on days that you are seeing a little bit of kind of a tech move, Relic somehow becomes one of your biggest movers, even though it's a fairly small company and actually doesn't have that big of a footprint in the AI space.
We'll just get you an update on what's happening with IHG, the hotels group. Just want to see what the number is before we talk to the CEO. Stock out of the gate this morning, a little softer, down by 1.19%. I want to put that in context. IHG has had a huge run-up over the last few months, and as a result of which, I think the beating expectations maybe isn't enough. Let's find out. The IHG CEO, Eli Malouf, joins us now to talk about the numbers. Great to see you. Thanks very much indeed for taking some time to join us this morning. Eli, let's focus first in on what we should be looking at here this morning. What is it? You've beaten, the numbers look good. The market is clearly looking at that, but I think it's maybe concerned as well about the fact that we're seeing a little bit of a RevPAR roll-off. Where should we be focused this morning in terms of the biggest tell on what is happening with the business?
Well, look, first I want to thank our teams around the world for delivering really what was an excellent set of results for 2023. You know, we saw strong demand around the world. The RevPAR was up 16% for the year, 8% in the fourth quarter. We're still growing all of our brands. We opened 275 hotels around the world. We signed over 550 into our pipeline with one of the strongest fourth quarters on record. Operating profit up 23% year over year for the first time over $1 billion. EPS up 33%. Put us in a position to return $1 billion to shareholders last year between dividend and buyback, and we're going to return over $1 billion this year. So really, I think it's a strong set of performance across the entire set of results, but really it's powered by a really strong business model. Brand portfolio that's iconic, and a strong, innovative, leading enterprise that compounds growth for shareholders.
The thing is, and you're going to know this, the share price has run up a lot. The market is now expecting a lot. It's seen how you can deliver. You just talked about your fantastic stuff. Can you sustain this kind of a growth rate going forward from here? Should we be worried about the consumer? Should we be worried about what's happening in China? How sustainable is the performance you've delivered over the last couple of years going into the next couple of years?
I think you have to look at the fundamentals. First of all, what powers our industry is the growth of GDP around the world and the growth of middle class around the world. And that continues. If you look in the United States, consumers still in very good shape. GDP growth continues. Wage growth continues. Job growth in January was double what was expected. Government spending on CHIPS Act, IRA, Infrastructure Act is strong. And that's been powering travel. And there's still some tailwinds that come into the United States from recovery of international travel and still some business and groups and meetings recovery to happen. If you move over to China, and I'm glad you raised the question, you know, we've been over in China for over 50 years. I was just there in September, spent a whole week with our teams. Got to look at the fundamentals of a $20 trillion economy. We just finished the Lunar Year, holiday. It was a record, 19% more travel than 2019. So while some sectors in China, we understand, are taking a pause, travel and hospitality is still very strong. Two key statistics you got to keep in mind about China. First, over the 10 years, projections are for the middle class to expand by 200 million people. If you put it in context, in the United States, the middle class is 100 million. This is 200 million people growing into the middle class. Second key statistic, rooms per capita. Hotel rooms per capita in China is 1/7 what it is in the United States. When I joined the company 10 years ago, it was 1/10. So it's more than doubled. And it continue to close that gap as the middle class grows and travels.
Well, Ellie, Kriti Gupta in London here. When you're talking about that wage growth, though, and how that factors into the end consumer, I imagine it also eats into your margins a little bit. Talk to us about the wage story, specifically in Europe, where some of your revenue numbers are actually coming in a little light. What's happening in this part of the world?
We had a very strong year in RevPAR growth in Europe last year. And yes, there's been some wage growth, not just in Europe, but also in the United States. Those things have frankly leveled off. You've seen inflation leveled off. You've seen interest rates level off. But you've also seen some strong rates, strong hotel rates. And from a hotel operation point of view, and really that's the P&L at the hotel operator point of view, we don't hold that P&L as ISG as an asset-light company. But at the hotel operating level, you need about $1 of revenue growth for $3 of cost. And that strong rate growth that's happened in Europe and in the United States over the last couple of years has more than made up really for the wage growth and other inflationary measures. But I think we've seen inflation level off in Europe. It never was a problem in China. It's leveled off in the United States. So the environment has improved from that point of view.
You're talking about China a lot. We're talking as well about kind of increases and strength and, or lack thereof, I should say, when it comes to the Asia Pacific region, when it comes to hotel, things like construction, specifically hotel construction. Ellie, if we're talking about this rates environment that is potentially increasing for the hotel space in the last couple of years, how does that translate to the construction business in terms of expansion?
Well, you had a period post-pandemic between supply chain issues, interest rate increases, labor shortages that did drive construction costs higher in most markets around the world. That's really leveled off. Supply chain issues have been mostly resolved. Inflation has leveled off. Interest rates have come down. But the stronger room rates have made up for much of it. And so we've seen, if you look at our openings last year, up 16% year over year. Our signings up 26%. One of our strongest records of signings in the fourth quarter. 50% growth year over year in signings in the fourth quarter. That's really a demonstration of the confidence that our owners and investors have in all of our brands and in growing in our hospitality business and growing with ISG. So it was a little bit difficult coming out of the pandemic, but the trajectory is improving.
Ellie, I'm listening to you. You're painting a really positive picture. Do you think the Fed needs to cut rates right now? If you look at the U.S. economy, and you look at the strength that they're seeing, do you think this is an economy that needs rate cuts? The consumer is absolutely surging, particularly in the service space. Service inflation remains very elevated. Is this an environment where you think we need lower rates?
We'll leave rate decisions to the Fed and to those experts.
Okay.
We look at the broad strength of the U.S. economy and the long-term trends. There's still a lot of white space to grow in that market. We look at the GDP growth. We look at the wage growth. We look at the low unemployment, the job growth that's being reported, and frankly, the strength in the manufacturing, the technology industries, the services industries continue to grow. You have some sectors that are going a little bit slower, but the great thing about the U.S. economy is when some sectors grow, get a little slower, some other sectors pick up. Artificial intelligence is employing a lot of people and growing productivity. So there are many sectors that are driving the economy when some slow down. And really long-term, the fundamentals for travel and hospitality in the U.S. economy are pretty healthy. This year, the forecasters are still expecting growth in travel and in RevPAR in the United States. So we're generally optimistic.
Final quick question as well from me. Any impact from what we're seeing in the Red Sea? Any impact from what we're seeing in terms of the Israeli-Hamas conflict that is currently underway right now? It's feeding out into the rest of the sector. Is that impacting travel to the Middle East? Are you seeing any impact in Dubai or Oman or other places within the region?
No, well, first of all, look, it's a tragic situation. We all hope for an end to the hostilities and to the suffering. Clearly, in the immediate conflict areas where we have a few hotels but not that many, we've seen an impact. And thankfully, our colleagues and our guests have been held safe, and that's really our primary concern. As you move to where most of our business is, which is closer to the Gulf, we really haven't seen much of an impact. I'm going there next month for a week visit, and our developments continue to grow. Travel has continued. There was an initial, concern and pause, but things have resumed in a positive direction. We hope that the conflict subsides, but our business has not really been fundamentally impacted so far.
All right, IHG CEO Elie Maalouf, thank you so much for joining the program. Of course, as we were speaking to Elie there, we are getting breaking pricing on Barclays. This is coming after they're increasing their capital returns, talking about midterm targets, rising 6.5% and still climbing now about 6%, but still a pretty massive move. It looks like this is in response to some of their new kind of targets that they're hitting. A £30 billion revenue goal for 2026. That's 13% above consensus. The market clearly appreciating that. That's just one of the moves we're monitoring. Joe Easton has got the others. Joe, what's on your radar?
So here's a couple of other big movers. Firstly, over in France, take a look at Air Liquide. This is a 90 billion euro liquid gas maker, and it's reporting really strong margins today, hitting a new record high. We've recently seen strong reports out of the peers like Air Products as well, and that is in line with those. But as I say, reaching a record up around 5% at the moment. Then we got Fresenius Medical, this one over in Germany. You remember that this is the dialysis maker that was hit last year by concerns around Novo Nordisk drugs reducing demand for their products. They're reiterating their cash flow guidance today and helping boost that stock. But the worst performer I can see this morning is Mobico. This is in London. Most people will know this as National Express, changed its name last year. Now, they also have a big German business, and they're delaying their earnings guidance due to some problems over in Germany. A shock announcement for them, and that stock dropping 20% today. As I say, the worst stock we've got on our screens at the moment. Then we'll flip over and have a look at those mining stocks, because we did have earnings out of BHP over in Australia. Most of the volume is in the Australian stock, but we are seeing The London-listed shares declining as well. Weakness in nickel. They've seen an 86% drop in some of their profit lines, according to the company. And we're seeing a feed through in Anglo, Rio, and Glencore. Got a couple of them reporting earnings. Also some weakness in the commodities prices today, generally hitting that sector. So that is a weak one this morning. We'll take a look at Bayer. This one was very, very volatile in the early phases of trading. I'll see where it's at now. So it's down 0.7%, a massive dividend cut, but largely expected by a lot on the street. So we've not seen a huge decline. It was down more than 5% on TradeGate. Analysts trying to make up their mind, is that cash flow saving positive or is it a negative? At the moment, down 0.7%. Then we've got a couple of morning calls. Sandoz, the generics business spun out of Novartis, gets its first ever downgrade. It goes to equal weight. This one is over at Morgan Stanley, who says that their generics business is potentially facing legal claims from the companies that have original patents. And then we just got breaking news that Bank of America upgrades the UK insurer Aviva, saying that Aviva has the best profits and dividend yields in the entire insurance space in Europe. Goes up to buy at Boffa, and that one rises 1.8% this morning.
Great stuff, Joe. Thank you very much indeed. Joe, running us through some of the equities we're watching. The name that really stands out to me this morning, though, credit continues to be Barclays.
Yeah.
Venkat, the CEO, talking about being very, very bullish on the business going forward. A little bit of the analyst, so the media calls just ramped up. We're going to get into the analyst call very shortly. I'm curious to see how the analysts take this, because some of the read-through so far are not exactly positive. So Citi is calling out Barclays. I'm just going to quote here. Citi is calling out Barclays' ambitions in the U.S. consumer market as, quote, the most unrealistic amongst the bank's new targets. The analyst doubting over at Citi whether they can achieve the goals, thinking maybe there's a non-core business. There's a great top live running TLIV function on your Bloomberg. You can find out some of this stuff. The analysts kind of calls I'm seeing so far, despite the rise we're seeing in the stock, a little bit kind of cautious as to what is happening here. I'm not entirely sure that the analyst community is on board with some of this, and the call may be a little bit more tough than the media call. Yeah,
our Bloomberg intelligence analyst, Philip Richards, talking about this kind of move. It's 13% above the consensus, which is adding to this kind of almost dreamboat-ness of these numbers. He's saying, look, you can't just make promises. You have to have them met. And right now, the capital distribution focus, it's welcome, but it's still a massive number, and they really have to deliver on it. A completely different take in the market, though. This is the biggest move you're seeing in Barclays shares since early 2021.
I think they needed this bounce. I think if they'd not seen a bounce in the share price, this could have turned south really kind of very fast.
But you know the problem with outperformance is everyone asks, well, how long can it last?
That's always the question. We just asked that question to the IHG CEO. We're going to talk much more about this. We've got some great guests lined up. We're going to be talking about the more broader market a little bit later on as well. More ahead. This is Bloomberg.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
This is Markets Today. We're about 20 minutes into the European trading day. On an index level, you are seeing a little bit of a somber move, but I wouldn't call it a massive pullback here. Your stock's 600, for example, just down about 0.3%. And that seems to be the general kind of take around the index, but it's the micro, it's the movers that we're really keeping an eye on. Specifically right now, the headline of the morning, Barclays, I think higher by about 6% this morning, really standing out in contrast to the somber move. Now 5.2%, they had this kind of restructuring into 5 different units. They had some buyback stories, my favorite part. But there's a little bit more to it. Guy, I'm going to let you dive in first.
Okay, so they're breaking it into 5 different units,
Yeah.
which I think is interesting. Is that going to tell us a lot about what is core and what's non-core?
Yeah.
They're, for instance, breaking up the CIB, so it's going to be C and IB. So maybe that gives you an idea of kind of how individual businesses are performing, figure out where you actually want to be, where you don't want to be. I think that's interesting in itself. The targets are quite aggressive, though.
They're quite high, 13% above consensus, according to Bloomberg Intelligence. Already some pushback you're seeing from some of the analysts. Let's bring in Tom Metcalf. He's our, of course, managing editor for finance here in this region. Tom, if there is kind of this dreaminess to some of these targets, why are the shares rallying this much? What's the market responding to here?
Well, there's a few things. Your favourite thing, buybacks, right? That's always an easy win, I suppose. And, in the context of Barclays' wider share price, before today it was down about 15%. So, it's definitely sort of overdue, maybe a bounce back, still woefully undervalued compared to other banks. So, look, I think broadly the market is in general terms welcoming this. But, yes, as you dig into the details, and over the next few hours we'll get more and more details, there might be some concerns about, how realistic is this? Or, there was a part of the Citigroup note broadly welcoming these moves, but pointing out that their ambitions, say, in the US card payment market might be quite ambitious, basically, and maybe hard to achieve just because, obviously, you've got a huge number of very, very good competitors over there.
Yeah, which are getting stronger maybe potentially after today's Capital One deal.
Yeah, exactly.
5 units.
Yeah.
Is that just easier to manage? Does it tell them what's core or non-core? Why that move?
Look, my read of that is a bit like yours. It sort of breaks things out a bit more clearly. So, previously you had the corporate and investment bank together, quite a usual structure, but actually what they've done now, you have a UK corporate bank and an investment bank, and then, investors and management will be able to see very clearly, what elements are really delivering, and also show to shareholders, like, hey, maybe in some cases the corporate bank was a bit overshadowed by the investment bank. That shouldn't be the case anymore.
If we're separating the commercial bank and the investment bank, it sounds like the investment bank has the most room to run, the most improvement to do. Can they come in line with the rest of the bank?
Well, it's certainly the key to all of this, right? So I think it takes up something like 63% of risk-weighted assets. So if they can make changes there, the aim is to bring it down to about 50% of the total group's RWAs. That will be where you can really see the difference. And this is sort of the eternal debate around Barclays, right? It's, can they make this big, gigantic global investment bank work and get shareholders to value it as executives see it should be valued?
All right, Bloomberg's Tom Metcalf, thank you as always for walking us through that story. Of course, Barclays shares still higher as we dive into the details. Not the only banking story we're watching. HSBC's results due out tomorrow. We're going to be speaking with the CEO of Europe's largest bank, Noel Quinn. That interview at 5:30 a.m. London time. Make sure to tune in.
Critty's favorite story of the morning. One of Critty's favorite stories this morning, other than the buyback story, but I guess there's a buyback element here as well. Buyout to slash its dividend by 95%. This as this business attempts to dig itself out of a hole created by the acquisition of Monsanto, which, of course, the maker of Roundup, and the legal cases that have unfortunately gone with that. Let's get to Munich now. Tim Lowe joins us. He follows Bayer pretty closely. Tim, they need to get their financial house in order. The dividend cuts, therefore, make sense. The question, I guess, is, does it go far enough? Just walk us through kind of what they're doing and how kind of this fits into the bigger picture of how they right the ship.
Sure, yeah. Well, if you go back a few months to the end of the summer, and Bayer was already facing a lot of crises. There were questions about whether its pharma division was going to grow at all this decade. They would need to invest in that, so they need money for that. There were questions about this litigation in the U.S. over Roundup and other products that they got from Monsanto. They've already flagged a lot of money, 16 billion plus, to handle that. But is that going to be enough? And then, they had this huge debt load. It was up to like 38 billion net financial debt. End of the summer, too high. And, in 2023, they had zero free cash flow. So, that's a pretty dire picture. But what happened in November is they started getting hit with a bunch more bad verdicts on the Roundup litigation in the U.S. And then they lost their top pipeline asset for drugs. It had a terrible results. And so suddenly these crises that were already there became a lot more acute. And so this company that has historically had a very generous dividend policy and has been very reluctant, especially as its shares have come way down, to punish investors even more by getting rid of the dividend. Basically, it's painted into a corner. It doesn't have a whole lot of options. So they've slashed it by 95%. Didn't eliminate it. There's a little bit left. And so the market is sort of, digesting this morning. What do we make of this? It's obviously, we're getting less cash from the company, but, it's clearly an important move for the long-term prospects for Bayer. But I think that, this might save them a couple billion a year over the next few years, but that's not going to be enough, most analysts think, for Bayer to really fix its balance sheet for the long term. So probably there are more things that need to happen.
Yeah, a lot to digest there. As you speak about, we're seeing the stock drop about 0.9%. Bloomberg's Tim Lowe out in Munich driving us through that story. And it's just, again, that almost quite thematic, I have to say. We thank you so much for joining the program. Quite thematic. And Guy keeps talking to me about how much I love the buyback story. The dividend story matters as well. But to me, it is still buybacks. I think this market is distorted. It's something we're going to be talking a little bit kind of big picture with our next guest from BlackRock.
And if you believe that stocks are undervalued, you would continue to deliver on those buybacks and use some of the cash. So it's going to be an interesting dynamic as to whether or not company CEOs, treasurers think their shares are fully valued. Okay, coming up, Europe's Big Smith, fourth quarter earnings haven't fallen this short of estimates in at least 4 years. BlackRock's CIO for fundamental equities joining us next.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things we have this great connection about the love for baseball, and the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Market Today. We're about 30 minutes into the European trading day, seeing a little bit of red on the screen, but it is absolutely going to be a kind of individual stock story. We just talked about Barclays, this big move that you were starting to see, kind of appreciating some of the structural changes that you were seeing in that company. But all in all, take a look at what is actually driving the index lower. A lot of this is commodities related, not just in terms of the likes of BHP, Rio Tinto, the miners, et cetera, but it's dragging down some of the oil companies as well, Guy. Commodities broadly actually seeing a pretty big macro read-through into today's session.
Iron ore's legging lower again now. So iron ore's rolling over. That's a China narrative, I think.
Yeah.
So you partly got the BHP numbers this morning that you need to digest and kind of think about what's happening with nickel. That's the read across into Glencore, as Will was talking about a little bit earlier on. But iron ore is a big part of that business as well, and it's down as well. We keep anticipating that China's going to deliver, and it's not. And that continues to be the problem. But iron ore also coming off a fairly high level. So we're kind of rolling off that too. So I think there's a bunch of factors coming through here. It's the BHP numbers, it's China, it's iron ore. They're all connected.
But I think you made a great point earlier. This is the second time I've complimented you in the last hour. I know, it just means I'm very sleep deprived is what that tells you. But LVMH is one of your biggest weights as well. And you made the point earlier that this was also a China story, which is interesting that it comes from a kind of property woes story, but then also from a Chinese consumer story. It's all showing up in the same way in today's trade.
So China, we had Lunar New Year, travel was high, so it was interesting to listen to IHG talk about how strong travel was in China, but spend wasn't significant, and particularly luxury spend wasn't significantly higher.
Yeah.
So that's the read across back maybe into what we're seeing from LVMH.
Yeah. On the upside, though, you are seeing some of the commodity names actually make their way up here. Shell, for example, is one of your index movers, but again, Barclays is going to be, I think, your second biggest mover this morning. So
let's talk about the earnings season more broadly. Let's kind of take a step back and figure out what is happening here. We're down, but we're pretty much in line with expectations. Now, European stocks are near record highs. Does this kind of all fit together at the moment? Is the lowered expectation that we're kind of beating to slightly matching enough to keep this stock rally on track? And do you believe that you want to buy Europe in this kind of environment, or the US, which continues to power on Magnificent Seven, the AI trade? We're going to get NVIDIA tomorrow.
But it's a similar story again, and I think you're the one again who brought this up, that 80% of the gains are coming from a handful of companies. But you know, I've ranted about this a little bit. I still think that the market is distorted. I don't think that making earnings in line with expectations justifies the gains that you're seeing, and I think a lot of it has to do with, say it with me, Guy, magic word, Buybacks.
There we go. There's the buyback line, which is a perfect place to start. So, Helen Jules, CIO for Fundamental Equities, EMEA, joining us from BlackRock. Nice to see you.
Good morning, guys.
So here we are. We've just been discussing it. Record highs, near record highs for European equities. Earnings look all right. We've matched expectations, but expectations were pretty low. Does this market fit together in your mind? Is it logical that we're near record highs?
Yeah, no, it really does, because I think although if you look across the board, it looks a bit in line, what you're really seeing is some of these quality companies delivering some really, really strong results within Europe, and the buybacks. The buyback story is really important. What does that do with the buyback? It delivers cash back to shareholders. What it also does is it tells you the management of those companies think that the shares are fundamentally undervalued. I mean, that is what a buyback is really indicating. So that is all bringing support to the European market, and support across different industries as well. It's not all concentrated in one place.
By the way, these two, they sat down and they started telling each other how much they love the dividend story, which at 8:27 in the morning is a little early for them.
The minute she said buybacks are important, can we just repeat that one more time?
What it also tells you, though, is that management has got a lot of cash and would rather buy back its own stock than invest.
Yeah, I mean, that is something that we obviously need to really understand. You know, what is driving those buybacks? And I think what it is also concerning, and I think one of the things in Europe that has been puzzling me a long time, is what is going to be the catalyst for the flow of capital into Europe? I mean, you did touch on it there as well. The US is obviously where you have the high return companies, some really interesting companies, particularly along the AI theme. So we need to make sure we understand that return of capital. What is it really indicating? Is it indicating not that they just don't see opportunities, but is it indicating that the valuations they believe is just too low? And they want to draw investors back into this market. They want to say to European investors, buybacks are back. It's always been a US story.
This speaks to the private equity story, though, doesn't it? Management is screaming out saying, we think our stock is cheap. The private equity industry is screaming out saying, this sector, this market is cheap. What was it? We were talking about Currys yesterday. Huge bounce in terms of that stock. Management thinks the stocks are cheap. PE thinks the stocks are cheap.
Yeah.
Private markets don't seem to be able to get the valuation story correct, judging by those two messages.
Yeah, but it's all kind of turning together. I'm going to bring it back to the public markets, because private equity is a whole other ball game when you talk about that.
It speaks to the valuation.
It does, but
management's saying these stocks are cheap.
They are, but I guess what I'm curious about is when kind of there is some sort of reality check here, right? Because when you're talking about buybacks, to me, and we saw this kind of iteration in 2018, 2019 as well, where you saw these kind of record issuances, record numbers in the bond market that then basically fueled the stock market rally, and then it kind of came back to haunt them later. A lot of these corporates, I'm specifically talking about American corporates as kind of the case study here, because it came back to haunt them later and saying that they're not being capitally disciplined for the oil companies, that they're not actually for healthcare companies taking their balance sheets into account. I'm wondering if we're seeing that same dynamic happen in Europe right now, where buybacks are driving this market. 2-3 quarters down the line, do we then say, well, actually, they need to get their debt load under control? And does that then come back to haunt the stock market?
No, I don't think it does. I mean, we got excited, Christy, about buybacks. I love buybacks too, but actually earnings are what is really important here. Yep. Those top stocks that we're talking about outperforming year to date, they had really, really strong earnings being reported. Yep. And what we're seeing, and we've seen actually during the first quarter, is a really strong dynamic of companies that have got strong earnings, quality earnings. They are the ones that have performed well, double-digit performance. We've got some of the early cyclical companies effectively calling the bottom of the market in there as well. So I think the earnings story is there to support everything. Yeah. Europe feels a little bit more stable. Yeah, we've still got these end risks. What if inflation gets out of control? What if recession does come back to haunt us? But those risks are relatively low. Geopolitical, we always have to keep an eye on. But I don't think it is buybacks that are actually fueling the market. I think it's earnings that are fueling the market.
But even if you look at some of the earnings, say some of the biggest corporate earnings that we've covered it on the show, where the profit margins are enormous. We look at IHG's numbers today, for example. They came in line with expectations, but a lot of these earnings are so dependent on what the U.S. economy is doing because of the exposure that is coming from that side of the Atlantic. This isn't necessarily indicative of European strength. Would you agree with that?
Yeah, no, I definitely would agree with that. I mean, the U.S. story is always incredibly important, and you know, we do need to just be very aware of what's happening in the US. We need to kind of just keep an eye on everything over there. China, of course, as well. Guy, you mentioned that this morning. Also an area that we have to be incredibly thoughtful and aware of. But they are risks. I mean, I'm not going to sit here and tell you with 100% certainty that the European market is going to continue to go up. However, on balance, those risks are being outweighed by the resilience and the quality of those earnings that we've been seeing coming through in the season.
But I've got to be in the right stocks.
100%.
That's the problem at the moment. And if any of those stocks falter, then I've got a big problem in my portfolio because my concentration risk is enormous. Now, you're going to tell me that they're in different sectors and therefore the risk is maybe a little bit lower than it is over in the United States, but the risk is still there. You get an issue with Novo Nordisk and it's got a manufacturing problem or whatever it turns out to be, then the risk in my portfolio is substantial. And any of those single stocks drop, I'm taking a big index hit.
I think you're taking a little bit of an index hit. I mean, there is certainly a little bit of a concentration risk on both sides of the Atlantic, and even if it's spread across sectors. But of course, I'm a fundamental stock picker. Yep. And therefore, I believe that what you really need to be understanding is what is driving those returns. If you are in the right place, if you really understand the quality and the resilience of those earnings, then I think, yes, there is that risk. It's never going to be zero, but the risk is relatively minimal, especially when you do have a little bit more breadth across the sectors. There are superstars across sectors in Europe. You're not seeing that quite as much in the US. And I think that gives you a little bit more of a story because if one of those stocks, if a healthcare stock falls, I don't think you're going to see the same read across as you're likely to see in the US if one of the names falls.
So for an international investor that isn't actively picking stocks and actively picking the superstars, what is the bull case to invest at the index level? Is there one?
In Europe, the valuations. Then it does go back to valuations. You know, Europe is still trading at 13 times. The US is much, much higher, around 20, 21 times. The UK, of course, even a notch lower than that. Now, these kind of valuations, you've really got to take note and take interest because the valuations do look compelling. And the other thing is, if you are too late within the market, the liquidity is still relatively stretched, in part because of that concentration, less liquidity in Europe. So if you wait too late, if you wait for it to move, you're going to miss quite a lot of that first stop. So don't ignore the valuations. I mean, you said it right at the top. The valuations remain important as well.
Helen, great to catch up. Come back anytime.
Thank you. Great to hear you.
Yeah, especially if you're going to compliment me this much on the show. Absolutely.
Thank you.
We need some balance. Helen, Jewel, thank you very much indeed. Okay, if you're on the way to the airport, pay attention to this next story. Lufthansa warning another strike set to disrupt around 100,000 passengers today. We'll get you the latest on what that means. Plus also what this tells us about the wage story. We'll focus on that as well. This is Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Very encouraged by the levels of domestic flying in China, which have been very, very significant. Last quarter of 2023 were very encouraging, quite a significant ramp up. Now it's still well behind where we were in 2019, but I think it's encouraging to see the direction of travel.
The IATA Director General, Willie Walsh, I have to say he sounds like he's got a pretty bad cold. I wonder whether that's kind of why he sounds a little croaky this morning. Usually on the front foot. Let's put it that way, Willie Walsh. He's always on the front foot. Anyway, that's the view. So Singapore, the air show's underway at the moment. I suspect that's why Willie's in town. The story here in Europe, though, is that Lufthansa is having to deal with the new strike. Potentially 100,000 passengers could be disrupted across five airports today. Third bout of industrial action that the German flagship carrier is having to deal with over the last few weeks. Are we close to a deal? Let's find out. Benny Campbell, who leads our global aviation coverage, joining us now from Berlin. Benny, we've seen a series of strikes. People are being really affected by this. How close is management and the Verdi Union to getting a deal done? Is this the last strike, or are we going to be dealing with this for some time to come?
I think the bad news is that it's the latter, that this will probably roll on for a while. This is a one-day strike, but it's hugely disruptive. As you say, there's about 100,000 passengers affected. Lufthansa are really running a very minimal schedule at this point. I think, a couple of flights taking off here and there. But if you want to travel into or out of Germany today, you're really in trouble. And Carsten Spohr, the CEO, he's had to contend with a number of these strikes. There was a Discovery unit, which is far smaller, and now the main line. He's kind of digging in his heels a bit, because what you offer now, that's going to be increasingly difficult to claw back later. So the company is trying to negotiate here, obviously, but the demands remain somewhat far apart. Verdi, the union, wants more than 12% in increases. And you've got to remember that inflation has come down quite significantly in Germany. So that's less of a bargaining chip at the moment. So Lufthansa will probably try and ride this out and see how things go. But this is probably not the final strike that we'll see.
Benny, what are the strikers asking for? Walk us through some of the kind of pay demands, pay negotiations.
Well, it's essentially still sort of remnants of what we saw last year, that inflation really was incredibly high. People felt that they weren't getting their fair share of the recovery that we've seen in the market. You've got to remember, since the end of COVID, we've seen a remarkable increase in flight activity. Lufthansa has really made a huge amount of money. The dividend is up. The company is buying aircraft. And that's really something we've seen across the board. And the workers are now saying they want a fair share of this. The costs remain high, living costs, so they're trying to get this out, and 12% is sort of the number that's standing out there.
I do wonder, Critty, whether or not some of the European airlines are learning the lesson from what we're seeing in the States right now. The US airlines came through with huge numbers for their pilots, for their unions, and now have locked in really high costs and are beginning now to see the impact as fares come down, that those costs are really eating into margins.
Yeah, something like 30-40% pay increases over a span of like 4 or 5 years just for pilots. But it also comes in contrast with some of the regulatory environment. That massive deal between JetBlue and Spirit was completely falling apart, just as JetBlue wasn't able to get those pay negotiations. And that was supposed to be their saving grace, and it wasn't.
It's a lesson that I think a lot of people are learning at the moment. These wage rounds, very aggressive at the moment in certain cases. Benny, the other question I just wanted to ask you this morning as well was about consolidation in Europe. It looks like Lufthansa's attempt to buy ITA, this was Alitalia basically, is going to face significant regulatory scrutiny. We've got other deals coming through, potentially. TAP's on the block. You've got Air Europa as well. There's been this push to try and consolidate Europe in maybe the way that we've seen in the United States. Are regulators really going to allow it? And what's the read across from this?
So the thinking at this moment is that they will allow it. There's a lot of political push behind the ITA-Lufthansa deal. The Italian government is really pushing to make this happen. Their argument is, look, we've tried for years to offload what was previously Alitalia. We finally found a solution here, and now Europe is making it difficult for us. Why? You know, this isn't fair. Please wave this through. Obviously, the European side, the regulatory side, needs to take a hard look at this. As you said, there's a bit of a precedent here. We have other deals pending. IAG and Air Europa is one. TAP, the Portuguese carrier, that will come on the market. We have SAS up in the north, and Air France looking at that. Or they've already made a bid for that. So they want to make clear that you can't just wave these deals through. You want fair competition, because on the other side, you have airlines like Ryanair, like EasyJet, like Wizz Air, who are standing by looking for ways to pick off some assets that will fall off the table from these deals. Ryanair has already said they're very much interested in Italian slots. This is a very hard-fought market, so whatever they can get out of this, that's good for them.
Yeah, similar story on both sides of the Atlantic. Regulatory pushback, as Critty mentioned, 2 deals. Benny, great stuff. Thank you very much indeed, as ever. Benny Camel in Berlin joining us on the latest out of the airline sector. The wage story is my other takeaway from this as well. We're going to get wage data, I think 10 a.m. this morning out of the Eurozone. We're going to watch what happens there. We've already seen some data out this morning suggesting the wages do remain reasonably elevated across Europe. That's what the ECB is focusing on. It's looking at it. These are the exact kind of deals that it's trying to figure out what they're going to look like before it makes a decision on whether or not it can cut rates. But
this is the exact conversation that you're not just seeing in Europe, but you're seeing it even in Japan as well. Isn't this the whole point? These massive labor negotiations that are going to determine basically the fate of central bank policy. You are not seeing that in the United States. That's where the rest of the world really diverges. You were talking about the competitive environment as well. The concessions are going to be really important here if the EU is ramping up this kind of scrutiny. They've already dived into things like Korean Airlines and their Asiana business, what the divestments look like. And I don't know if Lufthansa has that much to offer.
Well, it's in Italy it does. Lufthansa has consolidated a lot of business. So Linate Airport is one of the areas, particularly Michael O'Leary at Ryanair is talking about. MOL wants those slots. So it could just be a slot story.
Yeah.
You give up enough slots here and there, you allow people like Ryanair and Wizz in. That's enough competition maybe to kind of sate the appetite of the regulators. But I don't know, you're about to go on holiday. Airfares, you found a cheap flight. There aren't many about at the moment, I tell you. Certainly if you want to go during school holidays, it is still very expensive to fly right now.
Let me give you a tip that someone once told me that's been working beautifully. This is your air flight advice. Always fly on a Tuesday, because the tickets are the cheapest on Tuesdays.
Yeah, I don't really have that option. School holidays, but yeah, when they're a little bit older,
yes.
I'll be taking Wednesday, Thursday, Friday
when you're
off.
retired, just just fly on Tuesdays.
We're a little bit further away from that, but we're too far away from that. But it's going to be interesting. The other story, and Willie Walsh has been talking about this a lot over the last couple of days as well, is that we've got to make this big shift, the environmental shift that we're going through. We were talking about EVs at the beginning of the show. The auto industry is going through a really difficult transition. The aviation industry has got to go through a really difficult transition. Sustainable aviation fuel, super expensive. Again, fares are going to remain relatively high off the back of that.
I'm gonna pick your brain here. What does European hedging against commodity prices look like? Is the jet fuel pricing hedging as aggressive, for example?
The US don't do it. So you talk to Scott Kirby at United. There is no hedging, right?
What do you mean American does it?
The airlines don't. Airlines don't hedge fuel. US airlines don't hedge fuel costs. So you get much more volatility in terms of the fuel cost, in terms of the impact that you see. I promise you.
I trust you.
European airlines hedge more. Now, I think you talk to a European airline CEO, they'll say over the course of time, it makes very little difference. So in the US, they're prepared to take the price. In Europe, they try and mitigate it a little bit more.
Yeah.
But sometimes you're going to win, sometimes you're going to lose.
Yeah.
But US airlines don't hedge, so you get the much bigger effect coming through.
But I'm wondering that if you have these kind of wage price negotiations, which, by the way, you can't necessarily lock in yet because there are still higher inflationary pressures, it continues to persist, does then the hedging provide some sort of relief to make up for margins that wages may not?
Maybe. Depends what the fuel prices are relatively low right now. Relatively low.
True, but refining margins are rising.
The crack spread.
Yeah.
So if we're getting
really nerdy.
Alex Steele is going to be really happy having this conversation. I haven't talked about crack spreads for a long time. But yeah, no, the crack spread is really important because relative to the barrel, jet fuel is expensive. There you go.
It is.
Do you want to talk about Temenos?
Let's do it. Temenos is another major stock that we are watching. Of course, has very little to do with jet fuel. Holding its capital markets day today, it comes after the Swiss banking software maker said overnight that it's conducting an independent review of short seller Hindenburg's claims of accounting irregularities. Temenos, of course, disputing the findings. Bloomberg's Allegra Catelli joining us now this morning. Allegra, walk us through what we know about this investigation and what we might learn today.
Yeah, so the Temenos actually hired 2 law firms, one in Switzerland and one in the US, to carry out this investigation, as well as an accounting firm. They didn't specify the names of these, and the chairman said that the investigation overall was going to take hopefully less than 5 months. It had to be speedy and thorough given the seriousness of the allegations in the Hindenburg report. Which sent the shares tumbling more than 25% last Wednesday. The shares today are still quite low. So yesterday, ahead of earnings, they increased by around 10%. But today, the reaction is not that great. So we'll see what comes up at the Capital Markets Day today. There's a lot of expectation on it, for sure.
A lot of expectation. Morning, Allegra. Let's talk about the CEO. This company is struggling for leadership a little bit here. When are we going to get a new CEO? Kind of give us an update on the leadership story here as well.
So let's go back to 2022. A Petrus Advisor, an activist investor that has a 2% stake in the company, put pressure on the company to change and have a complete overhaul of management. They managed to get rid of the CEO at the time, Max Stewart, but Andreadis, who is the interim CEO right now, is still at the helm of the company. They are looking to replace him as well, and the chairman yesterday said that they were quite close to replacing him. I just spoke to him before as well, a little bit earlier today, and they said, and he told me that it was a big disappointment that they didn't find anyone. So sorry that didn't go through in the end, but they don't want to really give a timeline on finding a new person because they want to be prudent, and so yeah, that's what
we'll see what happens on that front. But yeah, this is a company that does seem to be crying out maybe for some leadership. Allegra, very nice to see you on TV. Allegra Catelli joining us out of Zurich. So that just about wraps things up. Wow, what a morning we have had. I'm just looking at some of the 52-week highs. You got some of the aviation stocks doing very well. Rolls-Royce, which I think is about to report numbers, hitting a 52-week high. Barclays is one of the big standout stories that we've been watching as well. Yeah. But Air Liquide, probably another story we haven't mentioned enough. That stock at a 52-week high. It's up by nearly 6% on the day. So some strong performances coming through. But the market, I think we're just waiting for the US to come back. I think, to be honest, we're really all waiting for NVIDIA.
I don't know. I feel like the commodity story is kind of writing itself out at the moment. The fact that you're seeing Glencore, Rio Tinto, Shell, BHP, I think Rio Tinto coming out tomorrow as well. So the miners conversation is going to continue throughout the week on kind of this weaker market in nickel, weaker market in iron ore as well. You have the Chinese, you have the Australians trying to kind of support it to no avail, it seems.
China. China's definitely another theme that's running through this market as well this morning. It's hitting the miners, it's hitting LVMH. It doesn't seem to have a big impact at an index level, but maybe it has a bigger impact at a single stock level.
Perhaps. Somewhere within there is also the tech space as well, and I think this is where the NVIDIA piece comes in. ASML, SAP, your 2 tech heavyweights of this index, lower, kind of sprinkled throughout those commodity names. So that's your trade, basically. Tech, commodities lower, banks slightly higher, thrown in there with Barclays and...
Yeah. So there we go. I think that is the European story this morning. Yeah. That's kind of the narrative that we've got. I think we're going to mark time. We'll listen to some of the calls this morning that are taking place, get a better read on what is happening. The Barclays story is going to remain really important. Then we'll get the US opening a little bit later on. We've got Walmart, we've got Home Depot coming up later on today. They could be 2 really big catalysts as well. Pretty smiling at me.
Love the Home Depot story.
There's like a toy shop. It's absolutely fantastic.
Such a dad thing to say.
Pulse is up next. Fran is coming up. This is Bloomberg.
I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, you know, any given day it would be the head of a studio and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Barclays surges as it vows to go on a major cost-cutting drive and return at least £10 billion to shareholders in the coming years. China ramps up support for the troubled property sector with its biggest ever cut to key mortgage reference rate, raising expectations for more aggressive measures to come. Plus, America warns against an Israeli assault on Rafah in a draft Security Council text as concerns grow about the humanitarian situation in Gaza. We'll be speaking to the former Irish president and chair of the Elders, Mary Robinson, about the growing global risks. Don't miss that interview. 9:30 a.m. UK time. Now let's take a look at the European markets map. A lot of focus, of course, is what's been happening in the U.S. Again, European stock, but also I would point to U.S. equity futures. Always a bit of a linkage between the two. Seem to be very cautious. So they're a little bit down. Again, a lot of cautious mood permeating the markets, despite some of the encouraging news that we had from China saying that they will support or put in place measures to actually support their ailing property sector. Now, I'm looking at miners. They're leading basic resources lower. I'm looking at Anglo American, Rio Tinto, and this is after a slump in iron ore prices. You can see the FTSE 100 practically unchanged, the CAC 40 over in France gaining 0.3%, but then we're seeing red elsewhere. For example, the DAX 0.3% lower. Earnings from Bellwether Nvidia on Wednesday will really provide some of the clues or some of the impetus possibly for further rally, or certainly a new impetus for equities as investors now trying to assess the strength of the global economy. So to talk about all of this, we're joined by Raffaella Tenconi, the founder and chief economist at ADA Economics. Raffaella, thank you for joining us. When you look at a lot of the concern out there and what the markets are telling us, I don't know what the catalyst actually for market economics is. I know we look about inflation, we look about everything that's happening with the Fed. Are you expecting inflation to come down?
Good morning, Francine, and thank you for having me. Well, actually, let me start a step back. I think the economy in the U.S. is really strong. I think growth will definitely be above 2% this year. But when you look at the inflation profile, some of the upward surprises that you saw in January and probably in the next few months, some of it is due to stickiness of services inflation. Some of it is the Suez Canal disruptions. But we think inflation will be at and below 2% in the second half of the year in the US. So it's broadly speaking on track with the Fed mandate.
Rafael, when you look at markets, and I know there's a lot of concern about debt levels, there's a lot of concern about the next catalyst for treasuries, or actually some kind of auction going wrong because of the debt levels. Like, is there any market event, any credit event that you focus on and worry about?
To be honest, the main thing that I worry about right now is the timing of the Fed cuts, because I think that very much shapes the labor market into the second half of the year and into next year. That, to me, is the most critical bottleneck we have right now, because when you look at auctions and debt levels, in my view, they are supported by the fact that we live in a world where there is a huge search for yield. So I don't think you will see auctions really going badly. But on the labor market, although I told you that US growth is strong, when you look at the granularity of data, the labor market in the US is weakening, definitely. The number of unemployed is going up, which is historically a very honest leading indicator. So to me, what you're observing is that as long as easing comes by June, doesn't have to be huge, but it has to happen soon, then the scale of the number of unemployed will be quite limited, and we remain in this soft landing scenario with quite a buoyant 2025. If instead, the Fed... Tell me.
No, I mean, is the concern actually that they take too long to cut? Would this be a policy mistake?
Yes, if they take too long to cut because they interpret the data as being still fundamentally bullish, then by the time they cut, whether that is September or even December, you would have ignited so many job losses in the economy that then we're actually looking at a much bigger problem, definitely in 2025.
Rafael, the concern I have is when you speak to central bankers, and this is, I guess, because of the complexity of the kind of world economy that we have right now, it's very difficult to pinpoint how much inflation is coming down thanks to central bank action. I mean, are we talking 30%, 40%? And the transmission mechanism, right, seems so much longer. So do you worry that we're looking at the wrong numbers?
Yes. We are measuring inflation incorrectly, I think, or rather incompletely, not incorrectly, so that it's creating a divergence between what people perceive to be inflation and we're actually measuring inflation. And this is a global problem, by the way, not just the US. But that, to some extent, is not exactly the main problem that we have at hand, because we do have a specific measure that the central bank targets. And ultimately, even if I believe that inflation is different than what we measured, the focus for monetary policy is still the measure. But what I think is happening is that this change between what is real inflation and what we measure inflation fuels discontent. So it has political ramifications, changes consumption, in Europe in particular. And ultimately, it's distortive in the long run, right?
So what can you tell us about the EU? I know you're expecting no real improvements in PMIs. Will we see cuts from the ECB before the Fed because of the situation here on the ground? And does that make a difference?
In our assessment, Fed and ECB cut both in June because we think that is what fundamentally should happen. And the magnitude of the cuts in 2024 is similar, is 100 basis points in our view. The implication of that, though, is that in the US, with 100 basis points of easing, you still have an economy that is going to largely outpace consensus expectation in 2024, maybe even 2025. And in the Eurozone, with only 100 basis points of cuts, they'll be at best stagnant, if not worsening, in 2025. So there is a euro-dollar implication that is very significant.
I was going to ask you actually about some of the currencies. What's your call on euro-dollar from here until the end of the year?
We expect it at 103 by the end of the year.
And then the great unknown is also what happens to Japan. How much do you look at Japan to see what they can or can't do? I have so many market participants saying, look, this is Japan's year.
Well, to be honest, Japan is not our primary focus, but from a perspective, like when you compare Eurozone with Japan, I think Japan more or less has a clear policy strategy, both on monetary policy and fiscal policy. It also benefits from the friendshoring momentum, so to speak. So Japan, it is Japan's year that after so many years of not really knowing what is going on, everything is going in their favor. Whereas in the Eurozone is really a year of transition, if not total obscurity, because you have funding costs that are too high to fund the business investment that they need. You have a lot of elections, with the European elections and the German elections coming into 2025. So there is real lack of clarity on what policymakers really want to achieve.
Rafaela, I have a viewer question. I think it's actually one of our regular viewers, so thank you so much for writing in. And they're asking you this question, Rafaela, which is basically, if you think the Fed is taking too long to cut rates, and you worry about some of the U.S. regional banks, and of course the refinancing of commercial real estate debt, could it all go wrong?
Yes, it could go wrong in 2025, definitely. I mean, you have to accept that there are quite a few lags. So I think 2024 ultimately will still be a good year. But I think if the Fed overestimates the strength of the economy, especially on the labor market, you will end up with a very weak 2025, and especially bankruptcies in the banks and the corporates that essentially fundamentally have too much of a weak model.
Rafaela, thank you so much, as always, for joining us. Rafaela Tenconi there, the founder and chief economist at ADA Economics. Now, Capital One has also agreed to buy Discover Financial Services in a $35 billion all-stock deal. The takeover creates the largest U.S. credit card company by loan volume. Now, it also ranks as the biggest merger globally so far this year. And you can see Capital One pre-market down 3.8%, Discover Financial 14.6% higher pre-market. Coming up, we're joined by the chief executive of one of the world's biggest shipbuilders, Fincantieri. We discuss the demand for commercial and defense, as well as rising geopolitics. This is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Now, the shipping industry is in the spotlight with heightened geopolitical risk across the globe, putting, of course, more pressure on transport routes and supply chains. Well, Fincantieri is one of the world's largest shipbuilding groups with a focus on cruise vessels, military ships, and offshore wind vessels. Now, the firm also says the underwater world is set to be a pivotal arena for security and technology worth around 400 billion euros. So let's discuss all of this with the company's chief executive, Pierroberto Folgiero. Thank you so much, Mr. Folgiero, for joining us. There's so much going on actually in your space because of cruises and because of defense. Can you give us, first of all, an outlook for the cruise ships? So we had COVID. That was a tough time. Are you seeing new orders coming in?
I believe there are, first of all, thank you for having me. I believe we are in very good situation because the occupation rates are back to the level before COVID. So passengers are there. Revenues yields, so revenue per passenger are at the level of pre-COVID. And I have to say that all the cash generation dynamics of those companies are back to a level before COVID. So there are the good preconditions for investment to come.
So give us a sense of, I know there's a lot of talks about a possible agreement, for example, with Carnival and an order for 5 billion euros. Is that something that you can confirm? Is that close?
We have a long-standing relationship with Carnival, who is a long-term client of Fincantieri since ever. We just delivered Sun Princess, which is the biggest ship ever built in Italy, as well as the first with a full engine room with LNG. Having said that, we prefer not to comment on current deals. We are committed to provide energy transition solutions to all our cruise customers, and we enjoy relationship throughout the market in this respect.
But can you confirm that orders are pretty strong? So we were just saying, I come from Genova. I mean, it's amazing when you look at some of these ports and you have like 5, 10, like massive ships. They're like, I mean, I've never seen anything so big. Are you going to see more orders for
For sure,
ships?
there is a very good momentum on the market, exactly for the reason I was telling you before. So financial conditions are back to before COVID. Economic performance is back the same level before COVID. All in all, the market is growing. The value for money of at-sea kind of holidays vis-a-vis onshore equivalent holidays, the value for money of the two are giving a good momentum to cruise sector.
Can you give us an outlook on the wind offshore sector? So how much will that grow by?
I believe it's another very, very nice tailwind for our business. You know that the offshore wind is the technology of choice. If you want to increase renewable energy production, our ships are the most sophisticated, are the one with more technology, either for the construction of wind farms and for cable laying, which is the other very important specialized vessels with respect to which we are envisaging a lot of growth.
So how much growth? Can you quantify how much in terms of orders?
Let me say the order book is being much higher than the revenues of the current year. So all in all, it means that there is a good momentum to have long-term visibility on these kind of revenues and production levels.
So how much are you planning to invest in? And again, if you can quantify, I mean, could that double actually in the next 3 to 5 years?
Our target in our 3 years business plan is to double the revenues for this kind of business vis-a-vis 2022.
And so that would be a bigger, I mean, when I look, and we'll talk about defense a little bit, but when you look at Fincantieri and basically where the revenue parts are coming from, how much will, offshore wind be part of that?
I consider that our current level of revenues is in the region of 7.5 billion, and the offshore wind ships kind of revenue will be 1 billion, 1.5 billion.
How much are you expecting in terms of defense spending from Italy, but also the European Union?
I believe that this is the era of defense. I believe that we are in front of a new geopolitical cycle whereby our historical partners, such as the Italian Navy and US Navy, are in the process of accelerating their investment program. On top of this, I believe there is a lot of room for exports, obviously along the line of the Italian and European geopolitical platform, but there is a big demand for naval assets in Middle East and Southeast Asia, i.e. the two theaters that are quote-unquote overheated because of the current geopolitical dynamics.
Can you also talk to us about the underwater, basically security? So what does that look like? And is this cables to service what sectors?
We are very, very focused on this new domain. I believe that is very similar to what was the space 40 years ago. So there is a lot of technology to be validated. There is a lot of new solutions and new needs to be fulfilled. Our idea is to start from submarines. We have a very long-lasting experience in building submarines. We built more than 180 submarines in our industry. So if you go underwater today, the first thing you meet, it's a military naval submarine. On top of it, there are a lot of technologies developed by the oil and gas sector for the management of operations in offshore subsea. So the combination of those two set of competencies will create the initial block of our competencies in the underwater.
But how many more submarines globally are you expecting there to be in 5-10 years? Again, geopolitics has probably never been so concerning. Are you expecting a lot of basically big major economies to just weapon up?
The underwater will be driven by two factors. First of all is the submarines business. Submarines are expected to become smaller, up to drones of 9 meters, 3 meters, unmanned 9 meters, for sure 3 meters unmanned drones. The mission will be initially the new doctrine of the Navy, according to which a military ship is a mothership, and all those items are connected and interconnected for a common task. Once you have validated this set of technology, including the telecommunications, which underwater are very different, it's all about acoustic and optic, but once this system is validated, then our vision is to go with a dual strategy to protect infrastructure, which is the first need of the underwater, telecom, and the seabed mining.
So these would be basically like small submarine drones, right, that would gather intelligence and send it back to the mothership. How much would they cost?
Come on. I don't want to unveil our numbers today, but what I can tell you is that the whole market of the underwater until 2030 is in the region of 400 billion. So there is business for a lot of new technologies.
So interesting. Thank you so much for joining us today. That was Pierroberto Folgero, the Chief Executive of Fincantieri. Now, coming up, Barclays soars after announcing a major cost-cutting drive with an aim to return at least $10 billion, or actually £10 million to investors. We'll have plenty more on the banking story next, and this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Now, Barclays shares surging this morning after it said it's going on a major cost-cutting drive in an effort to boost returns. Now, announcing a restructuring, Barclays says it will reduce costs by £2 billion by 2026. Now, the British bank plans to return £10 billion to shareholders over the period. Now, for more on all of this, we're joined by Bloomberg's Tom Metcalf. Tom, I guess it's a relief for a lot of management because their share price was under scrutiny. They hadn't been doing great. And then, boom, they're cutting costs, returning to shareholders, and their share price is up.
Yeah, I mean, certainly they'll be happy the share price is up. It would have been pretty awkward if it had fallen or stayed fairly flat. I mean, I think just to put that in context, though, Barclays shares over the past year before today were down something like 15%. So in some ways, they've still got a way to recover. But no, I think it's been an interesting morning for them. They laid out pretty clearly their strategy. And sort of my takeaway is, as we sort of expected, this is not some massive overhaul of Barclays. Barclays won't change from the bank we kind of know it. Instead, it's very much a look to scale up existing businesses like retail, the cards payment, while keeping the investment bank, but perhaps making it a relatively smaller part of the bank.
So, what will the changes actually look like in practice?
Yeah, I think that's the interesting thing. So what they're trying to do is get returns up at the investment bank. And look, the big question is how can
everyone is, right?
Well, exactly. It's not revolutionary, and how they do that is going to be interesting. And, there's a sense that they might target more or target businesses where they can make more profits, as you'd expect. Will there be some cuts there? Who knows? I mean, they've currently got a return on tangible equity of about 7%. To get to the group average, that's 12%. That's a big jump, right? So there you might see the most sweeping changes, all within the context of they want to keep this as a global investment bank. And then, on the retail side, likely they'll probably continue to sort of maybe look for opportunistic acquisitions. They just bought Tesco Bank, looking to bulk up that domestic UK bank.
Tom, thank you so much. We'll have plenty more, of course, of Tom throughout the week, because tomorrow we'll also be speaking with Noel Quinn, the HSBC Chief Executive, 5:30 a.m. London time. So wake up for that. Watch us, and then we'll get Tom to provide all of the analysis afterwards, maybe at 6:15. We'll let him sleep in for a bit. Coming up, an influential group founded by Nelson Mandela warns for a catastrophe for humanity unless world leaders take a long view. We'll be speaking to the chair of the elders, Mary Robinson. This is Bloomberg.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things we have this great connection about the love for baseball, and the reason why Warren and I got to know each other is he insured my contract, the 252, I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
Was going to keep bringing World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
Now, Barclays surges as it vows to go on a major cost-cutting drive and return at least £10 billion to shareholders in the coming years. China ramps up support for the troubled property sector with its biggest ever cut to a key mortgage reference rate, raising expectations for more aggressive measures to come. Plus, America warns against an Israeli assault on Rafah in a draft Security Council text as concerns grow about the humanitarian situation in Gaza. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. An influential group of global leaders has warned that humanity faces a greater catastrophe without what they describe as long-view leadership from world leaders. Now, the elders have written an open letter warning that the world is in grave danger because of threats including climate change and nuclear weapons. I'm now joined by the chair of the elders, Mary Robinson, who is also the first female president of Ireland and is a former UN High Commission for Human Rights. Ms. Robinson, thank you so much for joining us. Everyone watching now understands that we're in a grave danger. The question is, how do we make the world a little bit safer, a little bit less dangerous? What's your prescription?
Well, it's interesting that the elders felt it necessary to have an open letter calling for long-view leadership, as we call it, which means leadership that recognizes the complexity of issues and is thoughtful about, future generations in resolving those issues and has compassion about them. And you might think surely leaders would do that, but actually we're seeing more short-termism, more popularism. We're seeing the influence of social media. The attention span is very short. And, of course, elected representatives, those holding high office, want to get re-elected. I understand that very well. But we do need to address collectively very complex issues. These are the issues that the elders focus on. We call them existential threats: the climate and nature crisis, the pandemic crisis, and the nuclear weapons crisis.
But Ms. Robinson, there's a line of thought that says actually if you're a leader in the thinkers of the free world, then it's just much more difficult to enthrall, to enthuse, and to get people behind you. Is there a problem of communication, or is there a problem of values?
It's both, I think, and in particular, I come back to the influence of social media. We see influencers with big social media following. They may be very empty in their content, but they have big followings. And I think some politicians are copying that. They're trying through social media to be populist, to be very short-term, sometimes to be very angry. We know one particular man I'm talking about. He gives very bad example, but it's followed by leaders in different countries. We saw it in Brazil with Bolsonaro. We see it even in Korea, I'm told, that there's a populist potential leader of the opposition who's using the same tactics. And this is not the way that we need the world to move. we're finding it more difficult to get collective agreement, and yet we need it more. The world is far more threatened by threats that can only be resolved by international cooperation, multilateral cooperation, and yet we're seeing divides in our world, partly because of the conflicts.
Israel-Hamas has divided, it's extremely difficult for politicians to find the right way forward. On social media, there's a lot of cries to do something, and it doesn't seem that much is being done about it. What do you think needs to happen for successful talks on a ceasefire?
Yes, the elders have been calling for some months now for a ceasefire because we are very, very worried about what is happening to the women and children and civil population in Gaza, trapped in Gaza, trapped now without food, without water, without electricity, without internet most of the time, in great suffering, and then threatened at the Rafah crossing. So it is a very positive move, I think, that the United States now sees the need for a short-term ceasefire, I think they're calling it, in the current resolution that's coming before the Security Council. That at least is a step that recognizes that Israel must, this current government must listen. The whole world, I was in Munich with a number of elders, everyone was saying, we need a ceasefire, we need help to the huge number in Palestine who are suffering so much in Gaza, and therefore, we need, it's legitimate that Israel defends itself. It's of course very important that the hostages are released. The elders are very clear on that, but the attack on Gaza has from the beginning been disproportionate, and it has just got worse. And the population has been displaced over and over again, is now trapped in Rafah, and we must have a ceasefire, and we must get the humanitarian aid in. We must plan for what's going to be the future. A two-state solution is the only way forward.
But why has it been so difficult so far to call for ceasefire, and why have the U.S. not exerted more pressure on Israel?
Well, I think the problem has been this government in Israel, and in particular the leadership of Prime Minister Netanyahu. He has his own personal interests at stake. The longer the war continues, the less likely he is to immediately go be before a criminal court. And he's very unpopular in Israel. I think that there's a certain trying to continue his position. But actually, there's a real recognition now that things have moved in the region. And we talked to a number of high representatives of Arab states. They really want now peace with Israel within the context of a Palestinian state that lives in harmony with Israel and is supported by the region, and of course supported by the United States in particular, and by the European Union. And that is now more feasible. We really believe it's possible, but it needs a ceasefire now in order to literally deal with an appalling, unbelievable humanitarian crisis in Gaza.
A number of countries have also withdrawn funding to the United Nations Relief and Works Agency. Do you worry about that? Is there something that the elders want?
Yes, the elders have been very concerned about that because we know UNRWA. No institution is perfect. And if, as it is alleged, 12 members were part of that awful attack on Israel and the taking of hostages, of course that's completely to be condemned. And they were sacked without due process. 9 of them that are still alive, I think, by the head of UNRWA, whom I met in Dublin very recently, Lazarasi. He's worried that Israel now wants to get rid of UNRWA. Those of us who know the situation in Gaza know that UNRWA is absolutely vital. It's a pity that so many countries did immediately suspend aid because of this allegation, which should be dealt with forcefully and is being dealt with by UNRWA. There are investigations, etc. But you don't stop funding an organization immediately. That's very dangerous. I'm glad that my country not only didn't stop funding, but actually gave more money when the head of UNRWA was in Dublin. And other countries, Spain, Belgium, Norway, etc., have been principled in their approach. Unfortunately, I think the United States is probably no longer going to fund UNRWA, so the funding will have to come from elsewhere.
How worried are you, and how do you explain actually the rise in anti-immigrant sentiment across capitals in Europe, in Germany, in France, and also in Ireland?
You know, that's a good question, because that again is part of not having long view leadership. Who are the migrants who leave their country? They leave because they are desperate to get away from conflict, or maybe now increasingly they can't live there because of climate impacts. They are the strong, they are the enterprising. We should have legal pathways for more migrants to come to the parts of the world that are aging, in particular the European Union, because it's good for those countries. But we also have to control, illegal migration or migration that isn't regulated, because that threatens people. And the problem is then populist voices speak up about the other as if the other was not a human being. They don't talk about the stories of these people. They don't understand. But actually, ordinary people, I think, especially if they have experience of migrants coming in, welcome them. And we do need leadership that thinks long view, that thinks of the fact that actually the climate impacts are going to increase people being forced to leave. Conflict is also driving people out of their country. And we have to deal with this in a long view, appropriate way, through pathways of legal migration that are good for countries that have aging populations.
What will happen to Russia after the killing of Alexei Navalny?
Well, I think there was such a sadness in Munich, where 5 of us were there as elders, and we shared the sheer horror and grief at the announcement of that sad death. And it's inexplicable that the body is not being released to his widow and his mother. I mean, this is just really shocking. And it is indicative, I think, of a very ruthless leader who has committed this war of aggression against Ukraine. We had very good meetings about Ukraine, including with Alexei Yarmak, the chief of staff, when we were in Munich. And Ukraine needs the financial support, unfortunately, the support of weapons to combat this terrible war. And I hope the United States will pass the budget that is necessary for Ukraine.
But is Putin growing even stronger? And would a Trump presidency actually really embolden that?
Well, don't forget that Putin has been indicted for the capture of so many children to bring into Russia. Again, the elders are concerned about that. We're trying to see if it's possible to address that issue. But the International Criminal Court has indicted him. So I think this is part of recognizing somebody who is not just a bad leader, but actually inflicting terrible pain on a neighboring country, on Ukraine.
Mary Robinson, thank you so much for joining us, Chair of the Elders and former Irish president there. Now, the crew of a commercial ship have abandoned their vessel after it was struck by missiles in the southern Red Sea. There have been no reports of injuries on the Ruby Mar cargo carrier, but it's the first time that a crew has been forced to flee since the Houthi militants started to escalate their attacks off the coast of Yemen late last year. Now, let's bring in Bloomberg's Al Nightingale. Al, thank you so much for joining us. I mean, you cover this day in, day out. What more do we know about this attack in the Red Sea?
So the Houthis say that they sank the ship. We've reached out to the company that manages that vessel, and they've not been able to confirm that themselves. But there is every chance that the ship will have sunk, which would be the first time such a thing has happened during this escalation. So that's an important development, and will be on the minds of a lot of the crews that have to go through that stretch of water.
So Al, the European Union has also formally launched a defense naval operation on Monday, basically aimed at protecting some of these commercial vessels. What are the details of that?
Not a lot is known at this stage. The Greeks seem to be leading it from a European perspective, and I think that's kind of important, because what it tells you is how defensive it's going to be. There's not going to be a European kind of contribution to the attacks that we've seen on the Houthis, because the Greeks will want to ensure that their ships are safe for passage as much as possible. So it will be a defensive thing. It will be more protective than offensive. But the actual details, the number of assets, how it will operate still isn't known at this stage.
Al, thanks so much. Al Nightingale there with the very latest on some of these Houthi attacks. Coming up, more from our interview with the chief executive of BHP on earnings and the impact of lower nickel prices. That's next, and this is Bloomberg.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, you know, any given day it would be the head of a studio and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Now, BHP's first half net income has slumped 86% from the year before. The world's biggest miner says it's writing down the value of key assets due to oversupply in the nickel market. But speaking to Bloomberg, the chief executive, Mike Henry, says the firm's underlying performance remains strong.
In terms of underlying operations and financial performance, it was a really strong half. We had EBITDA up by 5%, net operating cash flow up by a whole 30%. Balance sheet remains strong with net debt at $12.6 billion. And all of that has allowed us to declare an interim dividend of 72 US cents per share. Now, yes, we have had a couple of exceptionals, including in our nickel business. Now, by way of a bit of context, the nickel business is the smallest by some margin business within the BHP portfolio.
Well, that was Mike Henry, the chief executive of BHP. Now, as many as 3,700 jobs are at risk at Anglo-American Platinum in South Africa. This after the world's biggest primary producer of platinum reported a 73% fall in profits. Well, let's speak to Bloomberg's Ondiro Oganga. Ondiro, so what's behind this huge fall in profits?
We have seen prices take a nosedive in the last year, and this is because automakers have decided to destock. Some of them are seeking cheaper alternatives, and also there's been a slowdown in the global economy. We saw the prices of palladium fall 46%, rhodium 65%, and platinum went down by 14%. And this is such a change in fortune because 2 years ago, some of these companies were reporting bumper earnings because the prices had nearly doubled due to demand. And also we're beginning to see that due to this change, the automotive outlook is almost flat this year, and prices are expected to hover around the current level. Because of some of these problems, profits fell by 73% just last year, and they had to reduce their dividends by 81% to 21 rands per share.
So tell us about the impact of the job cuts.
The job cuts are going to be steep because metals are the biggest exports of the country, and these job cuts will take about 17% of the workforce from the company. 600 firms will have their contracts reviewed, and this did not happen in a vacuum. In December, they reported their lowest earnings in 30 years, saying everything that they did to reposition the business did not work, hence necessitating the job cuts and also trying to reposition themselves a bit more competitively in the market in order to save more jobs and save money to a tune of $263 million. And this job cuts come at a very crucial time as South Africa is gearing towards the next general election. And even though we are seeing a drop in unemployment numbers to now 32%, all eyes on the government and what they'll continue to do to bring down unemployment unless they risk losing their majority in the coming elections.
Ondira, thanks so much. Ondira Oganga there with the very latest, of course, on what's going on in mining. Coming up, how should companies selling unhealthy foods deal with blockbuster weight loss drugs like Ozempic? We'll discuss the findings of the latest MLive Pulse survey. That's next, and this is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Now, the conversations that matter, the insights you need. This is The Pulse, and I'm Francie Lacqua here in London. So companies selling unhealthy foods need to tweak their business models to counter the growing popularity of weight loss drugs or risk alienating investors? Well, that's the conclusion of the latest MLive Pulse survey. And joining us now to go through all of this is Bloomberg's consumer goods reporter, Dasha Afanesava. Dasha, I love this because we all know it, but then it's now with Ozempic, it kind of focuses the minds, I guess, of some of these big company CEOs. So what do investors want the big companies to do?
Absolutely. The message is clear that they want these companies to shift towards healthier foods, which some of these companies would say, well, we've been doing that already, for example, Nestle, but then you'll have others like maybe Mondelez that mostly sells biscuits and chocolate. So they've been talking about switching to healthier foods because more because of regulation trends in terms of advertising and also consumer trends. But now they have this whole new reason to do so.
So how great is the threat?
Well, the jury's still out on that, really, because, of course, these drugs are only really popular in the US so far, and they are really widespread in the US, and they are very expensive, and they on the whole, require injections, although there is an oral version coming through from Novo. So I think that the impact might not be as great as these sorts of surveys would have you believe, also because some of these companies have been making that health shift gradually.
So how big is the impact also expected to be beyond big food?
It's been really interesting with these weight loss drugs and diabetes drugs, seeing how they impact different sectors. So gradually we're seeing evidence that they actually affect people's propensity to drink a lot and to smoke and other addictions. And there are also reports that it changes how you taste coffee and it makes coffee taste weird. So it's really interesting to see.
Not the coffee.
Exactly. There's a lot of sacrifices that could come if you're on these drugs. They were gradually figuring out how they impact different sectors.
But Dasha, and we've been speaking, to the Nestle's of this world. I mean, there's been so much focus on actually healthier foods by, a certain. Is that the way our tastes are going in general, or is it, just a certain population that's very aware of the risks and that is very focused on, for example, also like working out?
I think it's in general, there's greater awareness. And I think also regulators in some countries, for example, Mexico, there are curbs, there's big obesity problems. So there's been curbs on advertising, changes in labeling. So there's definitely increased level of awareness. But what these drugs allow people to do is to live by the truth that we know that, there are these unhealthy foods, either because of calories or other ingredients, sugar, salt.
Okay, I want to put down the chocolate and go for kale juice after this break. There you go. That's like my pledge today. Dasha, thank you so much as always.
Thank you.
Dasha Afanesava, there with the very latest on Ozempic and actually our wonderful MLive survey on what investors want some of the big food companies to do. Now, Capital One has agreed to buy Discover Financial Services in a $35 billion all-stock deal. The takeover creates the largest U.S. credit card company by loan volume. Now, it also ranks as the biggest merger globally so far this year. You can see pre-market, actually, Capital One down 5.6%, Discover Financial up 11.2%. Now, Barclays shares are also surging this morning after it said it's going on a major cost-cutting drive in an effort to boost returns. Announcing a restructuring, Barclays says it will reduce costs by £2 billion by 2026. The British bank plans to return £10 billion to shareholders over the period. Up next, Bloomberg Brief, Danny Berger and Manus Cranney in New York will have the latest roundup of stocks. Of course, U.S. futures retreating a touch. Again, I think investors are a little bit worried over China's economy weighing on global markets, even as we've seen some of the corporate news and earnings providing some bright spots. This is
you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They'd made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
This is Bloomberg.
Good morning from our world headquarters in New York. I'm Menace Crenny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
It's the biggest merger of 2024 so far. Capital One is buying Discover for $35 billion, creating a credit card giant.
Barclays soars as it vows to go on a major cost-cutting drive and return at least £10 billion to investors in the coming years.
And Walmart and Home Depot kick off the earnings report. A slew of retailers hit the tape today, offering investors the crucial insight to the financial health of the U.S. consumer. I helped. Did you?
Yeah, I helped. Maybe not at those places, but I've been spending, so it counts.
Okay, there's a wonderful thing I want to see, whether you got a Home Depot card. Let's talk about inflation in the bond market. It was a busted flush last week. You had PPI, CPI, and University of Michigan numbers came out as well. So let's start with the two-year yields over here, ticking up ever so slightly. Of course, we busted higher by 14 basis points on Friday. 5-year yields are at the bottom of your screen. This is where the real trade was. Everybody who wanted to tentatively be long duration went into the belly of the curve. So that's where you're just seeing the highs of 2024 being retested again. The market is reconsidering this. June is now potentially blown a hole and a rate cut in June. Just think, a couple of weeks ago, we were talking about 150 basis points for the year. Either way, that triptych of information that you had on inflation has shifted the dynamic on two-year yields. The euro, as Danny said to me this morning when I came in at 3:30, there's very little can save the euro. So if anybody has any ideas, please send it in. 107 at 96 is where we are. You've got stagnation nation in the UK and in Europe, and that hot, sticky inflation in the United States gives the dollar the alpha that it needs. It's aching the anemic growth in Europe, and that takes us to iron ore, down by nearly 6.5%, Danny. We're at a 3-month low. Again, the worst performing commodity, even though you've had the biggest cut in the loan prime rate on record in China. Is this alarm economics? Good morning.
Good morning, Manus. I just feel like maybe the one thing that could have saved the euro was a Fed that cut sooner. But I mean, last week's data. Yeah, exactly. The last week's data makes it seem like that's not going to happen. Look, for this equity market, for corporate America, the story of the weekend, the story of the day is the return of blockbuster M&A. $35 billion with Capital One and Discover. Capital One down this morning, Discover up as you'd assume. That's not helping the headline index, down about 1/3%. David Costin, though, over at Goldman says that we're going to get to 5,200 by the end of the year, thanks to healthy profit margins, thanks to big cap tech. Tech, though, down about 0.5%. We're nervous about tomorrow, about NVIDIA earnings, that could really shake up this market again if there is a miss. It is so crucial. And on options positioning, we'll talk about that throughout the show. It could be a volatility event. European equities down about 0.1%. Barclays not helping there. I mean, it is helping underneath the surface. It's up about 4% so far this morning on earnings, £10 billion being returned to shareholders in 3 years. Manus, you mentioned China. Chinese equities up slightly this morning, even though there was that LPR, a record 5-year LPR cut. But here's where equities are getting a boost. If you look at the ETF turnovers for Chinese stocks, a record volume exchanging hands over the past few days. That does suggest that the national team, Manus, they are in and they are buying.
Well, we like that because, let's face it, this equity market needs some kind of inspiration. The issue is the lack of inward investment into China and the outflows. The outflows have been significant and substantial. But when it comes to equity trading, the margin debt bounces this morning, and that's important. Stock traders take on more margin, Danny, up by 1.1%. That is the biggest uptick since September. Look, you're sort of grasping at straws at the moment in the China story as to a reason that why you would want to own the assets, because we simply lack the belief in them.
Yeah, I mean, the only thing you can say, I mean, not the only thing, but the main thing people say is we're down 50% from the peak. So it's just cheap. Maybe that's the reason you jump in.
I'd study your Fibonacci chart.
Ooh, getting into technicals. Tuesday at 5 a.m. I love it.
Morning. There's nothing can save the euro, and we're going to study Fibonacci levels. Well, there's a man who's got a little bit more insight into Fibonacci than I have. It is Paul Donovan. He's the global chief economist over at UBS. Paul, good morning. Don't test me on Fibonacci, please. It's been a long time. Now, the largest ever cut in the loan prime rate, which sets off alarm bells for some. We're waking it up in New York. It's 5:04. Why does policy action in China, which everybody on the street here has said is irrelevant, it doesn't touch America, it's not important for America, contextualize for me the correlation coefficient between policy moves in China and why it matters to Wall Street at 5:04 a.m. Good morning.
Morning. Well, it doesn't have a direct impact because Chinese consumers tend to consume stuff made in China. China is not a big impact on the global economy. But of course, it does matter to a lot of global companies. There are a lot of international companies, global companies that are making goods in China for Chinese domestic consumption. Now, one of the problems, I think, with viewing this rate cut is we've got to remember that China has moved into deflation since they last cut the long-term prime rate. So you've had now a falling inflation environment. That, of course, means that the real cost of borrowing is not actually coming down as rapidly as some of the headlines suggest, because you've got this negative inflation environment. That's a bit of a concern.
Paul,
ultimately, I think
there had been this narrative, Paul, that deflation would be exported to the rest of the world. Is that just not true? Is China isolated in that sense?
Yeah. So the thing is, China's deflation is purely parochial. And this is the case anyway. The idea that countries export inflation or deflation doesn't really hold water. Firstly, China's inflation story, very heavily geared towards food. China doesn't sell food to the rest of the world. Secondly, remember that if you're buying something in the US when Manus is tearing down the aisles of Walmart filling his trolley, if he's buying something made in China, about half of what he's paying is going for US labor costs. It's the retail, wholesale distribution, it's the checkout operator, if there is still a checkout operator, it's the advertising, all of that's local cost. So even if you're buying something imported from China, most of what you're paying for is still domestic labor costs. So no, China doesn't really export deflation to the rest of the world.
I haven't reached mania in Walmart just yet.
He's not the hedonist yet.
I'm not the hedonist yet. For DIY, it's not quite my thing. Now, Paul, China has a disinflation, a serious disinflation or deflation export momentum for the rest of the world. Why or to what extent do you believe in the stickiness of the inflation here in the United States of America? Last week was bruising. CPI, which everybody told us to ignore. PPI, which made it harder to ignore everything. I know it contributes to the PCE. And UMIDge. So it was a trifecta of, I suppose, substantiating evidence that we are going into a more sticky inflation environment here. Do you buy that, or is it idiosyncratic?
So I think it's very idiosyncratic. First thing, let's put the University of Michigan completely to one side. Doesn't matter at all. Consumers are useless at predicting inflation. They basically run off of food and fuel prices. You've got a situation where at the moment, the price of a Snickers bar in the vending machine is going up. Vending machine inflation is over 10%. That's the price that people remember. That's what they say inflation's doing. So Michigan, not an issue. When we look at the detail of inflation in the United States, January data is always noisy. There's always a lot of issues with seasonal adjustment, with companies putting through their annual price increases. We always get that in January. That pushes things up. But what really I think is very telling for me is that most of the United States is in quite a low inflation environment. You can make an argument that the US doesn't have an inflation problem. It's got a Florida problem and a bit of a Texas problem, because those two states have got very high inflation. Most of the rest of the country is still seeing inflation coming down, which proves it's not sticky. If you've got inflation coming down in Maine or New York or California, there's no reason for it to be sticky elsewhere.
So Paul, then how do you
policy.
solve a problem like Texas and Florida inflation? What does the Fed do? I mean, it almost feels like the Eurozone problem. What do you do when it's just two states, or maybe fewer or more, that are contributing to inflation and the rest is coming down?
I mean, it's a tricky issue. I mean, I think what the Fed can do is take comfort from the fact that inflation has been moderating elsewhere in the United States. So that suggests there's not a systemic problem. Now, if you have got a labor problem, or if you've got significant migration affecting inflation in one state, there's a limit, I think, to how much policymakers should pay attention to that. They should be looking at the country as a whole and not necessarily focusing to bring down inflation in a relatively small geographic area of the US.
So then, tell me this. I just spent a couple of minutes rambling on about bonds spiking by 14 basis points, and June rate cut has now been, almost thrown out. It could be July. The debate is now whether it's 3 or less rate cuts. I take it from everything then that you've said to me, if it's a Florida problem and if it's a Texas problem, then you must be a buyer of more than 3 rate cuts.
I think, yes. So I think what's going to happen is the Fed is going to follow inflation down. They do not want rising real rates this year. And in the detail of the inflation numbers, everything is pointing to a lower inflation print as we go through this year. So I think we'll end up the year around 2.5% inflation on the headline. With that, then, I think the Fed is bringing rates down to make sure that the real inflation-adjusted interest rate is not too high.
Paul, we do have the return of large-scale M&A. We saw it in the oil patch. Over the weekend, we get it in financial services with Discover and Capital One, a $35 billion deal. What does that tell you about where we are in this economic cycle?
Well, it's a very peculiar economic cycle because, of course, we've got big structural changes going on in the background. We're still sort of adjusting from the pandemic shocks, and that's still a feature. I mean, the fact that middle-income Americans have still got savings is a legacy of the pandemic. So we've got a very peculiar cycle, and I think what is happening is that companies are looking for opportunities to expand, to acquire innovation and new technologies, developments. That's a fairly normal thing given the structural cycle that we are in. We're not in the sort of frenzy of M&A that we've seen in the past, but that I think is also logical because we're in a more normalized interest rate environment now, and that's therefore changing cost of capital and companies' calculations.
Yeah, I like that. It's not a frenzy yet, but something is certainly in the water. Paul, thank you very much. Paul Donovan of UBS. All right, Manus, let's take a break from talking about your shopping and getting to some of the other top stories trending on the terminal this morning. As we just mentioned, Capital One has agreed to buy credit card lender Discover. It's a $35 billion all-stock deal. The transaction, which is expected to close in late 2024, early 25, would create the largest U.S. credit card company by loan volume. We'll, of course, talk more about that deal later in this hour, Manus.
Bayer plans to slash its dividend by 95% in an effort to dig itself out of a hole created by the acquisition of Monsanto. Bayer says it will offer investors only the legal minimum required under German law, paying 11 euro cents per share for 2023.
The U.S. has proposed a UN Security Council resolution warning against an Israeli assault on Rafah and calling for a temporary ceasefire. That's according to a copy of the draft text seen by Bloomberg. So far, the Biden administration has been reluctant to take steps to restrain Israel, but frustration with Benjamin Netanyahu's government is growing.
And President Biden says he's willing to meet House Speaker Mike Johnson to discuss a $95 billion emergency aid package for Ukraine and Israel. The White House is ramping up its push to pass the bill after the death of the Russian opposition leader Alexei Navalny and the recent fall of the Ukrainian city. Biden spoke yesterday in Washington.
They're making a big mistake not responding. Look, the way they're walking away from the threat of Russia, the way they're walking away from NATO, the way they're walking away from meeting our obligations is just shocking. I've been for a while. I've never seen anything like this.
Coming up, Barclays soaring after announcing a major cost-cutting drive. The aim, return at least £10 billion to investors.
And it's going to be a bumpy ride down to 2% inflation. That's the view from JP Morgan's Priyam Misra. She joins us later this hour with her call right here on Bloomberg.
Formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
It's Bloomberg Brief, Danny Berger and Manus Cranny in New York. Barclays shares, Manus, they are soaring this morning. The CEO says the British lender will return at least £10 billion to shareholders in the coming years. He said in a conference call to journalists that we are reorganizing the business in the way in which they face our clients and how we service our clients. And as simple as that, is it as simple as that, Manus? I mean, it's true. Yet again, another restructuring. Let's bring in Tom Metcalf. I mean, Tom, come on. It's another day, another time we hear about Barclays restructuring plans. I guess the market's liking it this time, though.
Yeah, look, shares are up. I mean, initially they're up something like 7%. They sort of fell back a bit to about up 4%. I mean, you know, as I look at this, it's largely in line with what we were expecting to see. You know, there's a real focus on basically every area apart from the investment bank. And I think the big question here is obviously investors looking at that big buyback, £10 billion over the next couple of years. And then the question is can they hit those returns targets, which, you know, our analysts at Bloomberg Intelligence are saying they look pretty ambitious, and that might be tough to reach.
I mean, ambitious is a very... Tom, you're so British, Tom, aren't you? It's rather ambitious. It's a tangible equity of 12% by 2026, right? That is, and I'm not the genius behind this, Bloomberg Intelligence are 30 billion in revenue by 2026. That is a 13% uplift in revenue. This is a hellishly competitive environment in the investment bank with volatile returns from FIC. We know that on a constant basis. Where's that promise going to come through from, Tom?
Well, I think this is the crux of everything, right? So right now, that investment bank has a returns on tangible equity of about 7%. And what they're saying under this plan is that needs to get up to the level the rest of the group's at, which is about 12%. So that's a big jump from 7% to 12%.
Yeah.
And I think your question, how on earth you do that in, like you say, a very competitive market is a really interesting one, because Barclays made it very clear they're not going to give any more capital to the investment bank. They don't want to do that. So basically, investment bank has to find a way, while its relative sort of capital allocation shrinks within Barclays Group, how it can actually become way more efficient and effectively make a bunch more profit.
And speaking of that, I mean, they're certainly not going to give people more pay. I know you and the team had a great story earlier in the month about the whole goose egg, the donuts being zeroed out for investment banker bonuses. I mean, what did we learn about pay this time? It seems like for everyone, the pay got smaller, the bonuses got smaller.
Yeah, sort of. We definitely saw bonuses fall sort of in aggregate. That's kind of as detailed as we get. But, you know, which again is expected. You know, a lot of deal makers at Barclays. It's been a very tough market there. And you know, that's the big question for me is how are they going to sort of make these returns jump? And obviously pay is one lever they can pull, but obviously that makes it harder to then be sort of a big name on Wall Street. And similarly, you know, might there be job cuts involved as well? Given they're targeting something like £2 billion of cost savings in the next couple of years, you've got to think that is something else that will be coming down the pipe.
Listen, I've often said when I come, what was it last year? When I come back in another life, I wanted to be a junior banker. That was in the middle of the pandemic.
Just don't be an investment banker if you come back.
Well, I don't think they'd let me back into an investment bank now. I left when I was 30. It's all changed. I want to come back and work for Andrea Orchel. He's paying bonuses. Now, talk to me about Noel Quinn. Noel being the ever steady as you go. I mean, he's thinking about the broader church of the bank. We're going to get the results. I mean, what's ahead in pay and remuneration? What do you think the message is going to be there?
Yeah, look, I think it's a nice contrast to Barclays, right? They are not going through a strategic revamp. They've had their plan to pivot to Asia. They've really zeroed in on that, getting rid of ancillary businesses. So yeah, I think steady as she goes tomorrow for HSBC results. And yeah, look, on the pay front, I think it won't be fantastic. It won't be like a UniCredit like you just mentioned. But equally, I don't think there's going to be the big changes that we might be seeing at Barclays.
Okay, now you know where to send your CVs. There or Santander. I mean, it seems to be, you know, the Italians and the Spanish that are paying up. Tom, thank you very much. And the Swiss. Tom Metcalf on the banks. Shall we have a little look at the bond markets, Danny? Because it's interesting what Donovan had to say to us in terms of the US doesn't have an inflation problem. What does it have? It has states.
It has a Texas, it has a Florida problem, and the Fed can take confidence in that.
Absolutely. He's still a buyer of rate cuts. Yields dropped ever so slightly this morning. We had quite a punchy session on Friday with short end of the curve moving up by 14 basis points. You are just looking at coming back from some of the 2024 year highs on 10-year. And gilts drop by 5 basis points there this morning. So a little bit of relief across the bond markets.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg Brief, I'm Manus Cranny alongside Danny Berger in New York. Now, are they weighty? This is the Apple Vision Pro. Mark Gurman, our columnist, has been out, spoke to a few people. The Vision Pro apparently is weighty, and people are returning them. People are returning their Vision Pros.
Maybe they just decided they wanted that $3,500 back, that they could spend it somewhere else. But yeah, the tech team basically went out to a bunch of different retail channels who monitor this and found that returns, because we're in that 2-week return period, it has been 2 weeks, are either average or above average. But this gets back to that Mark Zuckerberg, beef video where he's out on X talking about, hey, our Meta goggles are so much lighter than Apple's. But hey, maybe he has a point here. If people are returning the things because they're too heavy and they also don't like the glare.
And apparently the productivity, well, what did you think when you put a pair of goggles on and you live inside a zone where you can touch? Your productivity apparently is not materially higher when you use the Vision Pro relative to using the Mac. But here's the thing. What about the second-hand market where we're going for $5,000?
Crazy. Well, if everyone's returning it, maybe you don't need to wait for the second-hand market. I also love this. One of the reasons people gave for returning it was isolation from family and friends. Again, what did you think was going to happen if you put on a pair of ski goggles in the middle of a family reunion?
How are you going to feel if I wear the Vision Pro during the show?
During the show? I mean, I don't think you can. That'd actually be cool. You could get the prompt in the thing. Maybe you do it.
Then the viewer wouldn't be able to see our eyes. And then the other thing that Apple's got to contend with as well is over the weekend, the EU, we understand, ready to slap a fine on them for 500 million. I'm just going to check whether it's dollars or euros. 500 million euros because of a lack of competition with Spotify and other providers out there in the app world.
Yeah, and I have to say, just thinking about competition and fines, I know this is about the EU.
Yeah.
But it goes back to Capital One and Discover. Is that merger going to face regulatory pressure? Again, I know it wouldn't be from the EU. It would be from the US, but it has been a more fierce US regulatory environment right now.
Yeah, I mean, it's a huge deal. It's going to be the biggest of this year. We're going to dig into that deal in just a moment. But one thing which is going to be the underbelly of risk over the next 24 hours, it is NVIDIA.
Yes.
$1,000 calls trading.
Yes, I mean, the options build-up is huge. It could be a volatility event.
Could be Volmageddon. Take two.
Ooh. Scary stuff, Manus.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
You're welcome back. It's Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger. Here's what you need to know.
It is the biggest merger of 2024. Capital One is buying Discover. The price tag, $35 billion to create a credit card giant.
Barclays soars and vows to go on a major cost-cutting drive and return at least £10 billion to investors within 3 years.
Walmart and Home Depot kick off the earnings reports for a slew of retailers today, offering investors the crucial insight to the financial health and the hedonism of the U.S. consumer.
All right, we might have those earnings, Manus, but you know my favorite line of last week was investors wake up.
You can remember last week.
Yeah, somehow. Investors wake up and check NVIDIA, and that's all they do. They don't care about bonds. They don't care about Home Depot. They wake up and they check NVIDIA. I love that.
The biggest open interest is at $1,000 calls, 33% up from here.
Yeah, and look, that might be part of the reason why there's some nerves in this equity market this morning. Let me show you what they're doing, because we are solidly down in the future session. So far, we're down by 0.4% for the S&P. This does look to be about the lows of the morning. So we're continuing to fall as we get closer to the U.S. Open. Now, we did get an upgrade from David Kostin, the Goldman Sachs team, for their year-end price target, 5,200. They say tech is doing well, margins are well. Tech, unfortunately, not doing so well this morning, underperforming 0.6%. Again, a huge options buildup around NVIDIA. Most of it is calls. We're expecting the upside, but does that mean it's a Volmageddon moment if NVIDIA disappoints? Finally, European equities. Little change this morning, Manus. They're likely helped by Barclays' £10 billion pounds being returned to shareholders, but the bonus is maybe not so as generous as that.
Yeah, some pretty significant promises coming through from the CEO there. Now, we busted out a few moves on the bond market on Friday. There was 3 major events, which, interestingly, UBS has just washed away any issue to do with the UMich data because Paul Donovan just thinks it's completely irrelevant. It's highly politicized at the moment. So yields are coming back ever so slightly. We were up by 14 basis points on Friday. The whole world was long the belly of the curve. If you're going to take a duration trade, probably it was in the belly. And that's why you saw such volatility in the belly of the curve on Friday. You tested the highs of 2024 there. Euro dollar, as you said, Danny, this morning, what can save the euro? I mean, literally, you've got ministers in Germany giving the economy 4 out of 10 in terms of performance. This is about interest rate differential and growth differential between the Eurozone, the UK, and the United States of America, hence putting a cap on the euro trade at the moment. So you are just looking at that hot, sticky inflation, punching rates higher, supporting the dollar here. Iron ore is, I think, a very indicative trade, battered to a 3-month low. It is the worst performing commodity so far in 2024. BHP Billiton says the market will be broadly balanced. You see this emergency reaction function from the Chinese, the biggest cut ever to the loan prime rate. That is trying to put a floor under the housing market in China. Danny?
Of course, Paul Donovan, speaking to us in the last half hour, said that China does not export inflation to the U.S. Because you think about a lot of their deflation, of course, export deflation is what I should have said. You think a lot about their deflation, it's in things like food prices, and they don't export food and those kinds of crops to the U.S. So it's a China story. It's not a global story.
My favorite phrase out of the conversation with Paul was, it's a parochial problem. Inflation, disinflation for China is parochial. It does not have the same impact on a global basis, but from a company perspective, that's where the equity market has got to pay a little bit more attention on a global perspective to the China story.
I thought you were going to say your favorite line was him saying you shop too much at Walmart.
He has this vision, he engendered this vision of me in Walmart with a trolley just sort of furiously shopping.
I love it, and probably none of it is for me, and that breaks my...
I haven't found a Walmart.
We're in New York City. You don't really go to Walmart. You know, you go to the bodega and say hi to the cat, and that's about it.
Yeah, I find Home Depot.
Yeah, well, it's in the building, so that
didn't last very long.
Okay, well, look, we got a view into the spending and to where prices are last week, and it was perhaps a frightening view. We had both CPI and PPI, both Manus, were above expectations. We've been talking about this, and it leaves investors wondering, is inflation maybe stickier than we thought? Does that undo the path downwards in inflation? Well, JP Morgan's Priya Misra writing in, quote, "It's too early to say with any conviction that the lower trend in inflation is gone. We need more data to draw conclusions, and I think the recent data just proves that it is unlikely to be a straight line lower in inflation to the Fed's 2%. Priya joins us now on set. She's fixed income portfolio manager at JP Morgan Asset Management. Priya, I like this because it forces people to calm down some of their hashtag hysteria from last week. But in a way, does that mean, okay, it's going down, maybe not a straight line, but if we're at year-to-date highs for yields, is that kind of the ceiling where we're at right now?
I would argue yes. I mean, you know, we've heard from Fed officials that they're getting ready to cut rates. They're debating March, May, June. It really doesn't matter. They're not pushing back that they need to cut rates. I think if you look at long and real interest rates, they're close to 2% on the 10-year. That's extremely restrictive. So the reason I think we're near the highs is we've taken out a lot of those Fed cuts that were priced in. We started this year with the market pricing in the end point of cuts. So I actually look at the total amount of cuts. You know, whenever they start, I think it's somewhat irrelevant unless you're trading Fed fund futures. Right. It really matters in terms of total amount. We're now pricing in 375 in terms of that Fed funds rate at the end of all the cuts. The Fed thinks 2.5 is neutral. I think I might be more in the 3% camp. We're pricing in 375. So I think we've had a lot of volatility. The market is extremely skittish because I think everything rests on a soft landing, which requires the Fed to cut, and it requires inflation to continue to decline. And I think the data hasn't quite cooperated of late.
It is noisy. There's no doubt about it. And I quite like what Paul, we didn't actually get the chance to show it on screen, but he talked about the University of Michigan as being, you know, sentiment data that offers entertainment rather than substance, providing a breakdown of Republican and Democrat sentiment. I mean, that's an interesting take on that. But he did say America has a Florida and a Texas inflation problem. So can the Fed go ahead and start the process without a taming of inflation in Florida and Texas? Can you act with impunity if you've got two massive states with much higher than estimated inflation?
So I think that's fair, but you know, we're starting from 5.5 on Fed funds.
High level.
So if the Fed says we're normalizing, I think it's going to be much harder when they get to 4.5 or 4%. How much further? Are they going to go all the way to 2.5? I think that requires inflation at 2. But we're starting at 5.5. We're starting to normalize. I think the Fed can still say, look, inflation was 9%, CPI was 9%, and it's running at 3. We can start the process. They can go gradual. Yep. They know monetary policy is restrictive. I would agree. University of Michigan, I mean, look at the response rate. Look at how many people, I mean, the average person on the street, I know you both are not average, but you know the inflation's.
I'm Irish, I'm not even American.
But most people argue inflation's so much higher than it's running. Yeah. I think because it's a sentiment indicator. CPI, True. PPI, service inflation. So you talk about the Fed, I think the Fed's going to look at service inflation, wage inflation. Are rents coming down? This last report, rents are coming down, but if you own your house, that inflation went up. Yeah. So that's odd. That's a calculated number. It's noisy. I think the market focuses on every data point. We're going to watch the minutes and lots of Fed speak. I think they're going to tell you, we're looking at the broader trend. They don't change their mind every data point. No. They're not data point dependent. They're data dependent on average.
That's a really excellent way of putting it. I haven't heard that before. Priya, I mean, a lot of the focus in this market has been on the frothiness of tech, and maybe perhaps a bit overlooked is potential frothiness in this credit market. Manus, you and I were talking about it this morning. I mean, there's been this insatiable appetite for bonds right now, for corporate bonds. Yields are the tightest, spreads are the tightest since 2022. But then you look at default rates, okay, they're not crisis level, but they've creeped higher. Is there enough risk priced into this corporate bond market right now?
So I think in the investment grade market, companies have delevered significantly. And if we're in a soft landing, if growth is still okay, 1.5% to 2%, I think those spreads can actually stay here or tighten further. There's also a huge positive technical. There's $6 trillion sitting in money market funds. You know, cash is never a strategic asset. It's been hiding there. It's felt great as the Fed was hiking rates. As that money starts to move in, that positive technical can get corporate bond spreads tighter. But I will say you have to do your credit work. If monetary policy is tightening, and it's very tight, there's going to be companies that are going to struggle. So we look at balance sheets, business models, just to see, make sure you know what you own, and make sure you're okay with the companies that you buy. So I think that credit work, it's hard to just buy any corporate bond, but if you do that work, I still think there's value in owning some of these investment-grade corporate bonds.
You have made that point before. I mean, I've been with you on surveillance and on other conversations where you say, look, do your detailed work if you're gonna buy investment-grade credit, or even a little bit higher. So with that in mind, I mean, the money just keeps flowing in. 16 weeks of inflows is what we've got into credit. And the question I ask everybody is, this 6 trillion, 7 trillion, whatever it is left sitting in money market funds from individuals and from institutions, when that flow begins to trickle out, do you think it's going to be an equitable distribution between credit, bonds, and equities? Because this equity market, I mean, Goldman's up being at 5,200?
Yeah, 5,200.
Which isn't that far away. So where do you think investors are going to feel safer in terms of a return? Because to me, I'd feel safer in credit, but who cares what I think?
So that's the 6 trillion question. Where does that go? I would say somewhat equitable, because in a soft landing, it does depend on, are we soft landing, hard landing? Yeah. We're getting into a hard landing, the Fed's cutting much further. I think it's all going to bonds. It's actually going to government bonds. But if we remain in a soft landing, everything is well priced. But at that point, I have reinvestment risk. As the Fed's going to start to cut, I think it does go into risk assets, also goes into bonds. We should look at correlations. There have been no stock bond correlations for the last 2 years. Yes. The Fed starts to cut, and at that point, those correlations come back. So if I own some risk assets, I really should own some bonds too. What if the economy does weaken? And recessions are always nonlinear. Every hard landing starts looking like a soft landing. That's why I think I like your bond point. As a bond person, I might be biased that more should go into bonds. But I do think there'll be money in a soft landing that's going to go across asset classes. But bonds should get their fair share.
But isn't there some element of cash that's, at least to this point, has been more sticky than we thought it would be? We thought that last year was the year of cash. That would start to get allocated. So far, it hasn't this year. It's still a massive buildup. Even when it does come out, do you think it's less than maybe some people are expecting?
I think it depends on valuations. Right now, if the Fed starts to cut and that money moves out, every market's so well priced for perfection. I think, to your point, some of that cash remains. People want to wait for that opportunity, but any backups will be bought. Bonds, stocks. So I think it all depends on really valuations, and right now
and
we
what
have
NVIDIA does tomorrow.
We're very curious to know, to what extent are you and the team sort of talking about NVIDIA? Will there be an NVIDIA impact, a psychological impact, just briefly?
We are.
Does it creep into the bond desk?
That's so interesting.
Absolutely.
The bond desk is talking about NVIDIA, Priya.
Given how much the market's moved, you have to look at that, and it's all about sentiment. And so absolutely, we look at every market, including NVIDIA.
I'm scared for tomorrow, Manus. I don't think I'm
frightened.
ready for it.
I'm here.
Thank you. You'll guide me through it. I appreciate
absolutely. Yeah, you, me, that's why I'm a journalist, not a trader or a broker anymore. Priya, thank you very much. Priya Mishra, very latest views on the potential for correlation coefficients coming back. Coming up on the show, Danny and I are going to dig into Capital One. They agree to buy Discover. $35 billion is the price tag. It is the biggest deal of 2024 on Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Bloomberg Brief. I'm Manus Granny with Danny Berger alongside me in New York, and it is the biggest deal of the year. Capital One acquires Discover. The price tag, $35 billion. It's an all-stock deal, creating the largest credit company by loan volume. Charlie Wells is with us. Charlie, this is going to be a beast in terms of volume. It's going to overtake JP Morgan and Citi when it's created. But the context around this.
Yeah, Manus, I mean, this is a big deal, and this is a big deal. So what Capital One gets here really is prime borrowers and also a payment network. So what's interesting about Capital One is they long have targeted subprime borrowers, the sorts of credit card users who have balances on the end of their statements at the end of the month. What they get here is Discover's prime borrowers, those who have higher credit scores. But what's also always been interesting about Discover is they own 3 payment networks, and that is something that's going to be very attractive to Capital One as they try to compete more with Visa and MasterCard.
Charlie, the trauma that Manus knows well from me of moving back to America and struggling to get a credit card. I'm not happy at all. The credit card company who didn't give me a card shall remain nameless, so I'm not going to blast them on Bloomberg TV. But tell me how things are going to be different now. Maybe I'll get a card more easily, but how does this reshape the American credit card wars?
Well, there really has been a race to the top in a lot of ways in that premium market. You just see, the Chase Sapphires, the Amexes, creating more and more expensive cards, more and more kind of, high value perks for a lot of these prime borrowers. So this could potentially add some competition there. I think what's interesting also is what happens beneath. And we know that these payment networks have been so controversial over the past few years. Credit card issuers have been really trying to gain some leverage here. And so this could change things. And interestingly, Capital One is the 3rd largest issue of Visa cards in the United States. So this could add some pressure to the Visa and MasterCard networks that they've already been feeling for a long time. I mean, we remember just a few years ago, and this is from the merchant side, Amazon putting pressure on Visa here in the UK because of the fees. And so this is something that could certainly shake up that kind of high-end perk, but also the networks beneath.
Yeah, and then we have a complete revolution in terms of payment networks here in the US and in Europe, in terms of the technology, the new technology entrance into this. So talk to us more broadly about, we've got oil mega merger deals going through, we've now got credit card mega merger deals going through, we've got some savior deals which will come in regional banks, I presume. But where are we in terms of setting the stage for broader deal making this year?
it's got to be better than 2023, right? I mean, it's looking fairly positive as 2024 kicks off. You know, this is now the largest merger of the year. And I think what's interesting, look, is when there are good deals, it seems like the powers that be want to pounce. And this, in a lot of ways, must have been really difficult for Capital One to look away from. I mean, Discover, I believe in January, they'd announced 62% drop in profits. And so a situation like that, where they had some regulatory and compliance issues, I mean, this would have been really hard not to pounce on. Of course, this will still need to go to shareholder and regulatory approval. The expectation right now is if this happens, it could happen in the end of 2024 or early 2025.
Yeah, I mean, 2023, what a low bar to set. Anything looks better than that. Charlie, thank you very much for that. That's Bloomberg's Charlie Wells. All right, let's get in from consumer financials to consumer earnings. Home Depot and Walmart are set to report before the bell today. Sales growth is going to be in focus for both retailers. Let's get over to Bloomberg opinion columnist Andrea Felstad. Look, the debate has been the health of the American consumer. Are they spending just on credit? Are they spending more on Walmart because they're trading down? What might we learn from today's earnings?
Well, it's all going to be about the US consumer. And we've had very mixed messages. When they reported in November, Walmart talked about a fall off in demand in the last 2 weeks of October. Target talked about consumers holding off from purchasing things like winter clothing until they really needed them. Since then, we've had a pretty decent holiday season, but January retail sales were weak. So I think we'll be seeing whether that is a typical, post-Christmas hangover, the credit cards bills come in, or whether this is the start of something more protracted.
Danny's waiting for that ability to spend on her credit card, so she is.
Fingers crossed it happens one day.
She is restricted as we speak. There is a savior for us all.
Yeah, at least the spending won't come from me. That's the benefit.
So talk to us about deflation. I mean, we've just spent 45 minutes talking to an economist and to a bond expert on deflation, disinflation from China, the idiosyncrasies of inflation here. But these companies can tell us where we are in the reality of live deflation. What do you think we're going to hear, Andrea?
Well, in November, Walmart said they expected to see deflation on things like, home furnishing, clothing. Now, since then, we've had all those problems in the Red Sea, which is adding to shipping times. It's taking 2 to 2.5 weeks longer to get goods to the US East Coast, and freight rates are going up. So it'll be interesting to see whether that really puts a brake on some of that deflationary impetus that we had expected to see.
Andrea, what about Home Depot? It feels like we're so far away from that world of 2020 COVID DIY home spending.
Exactly. I've called it the great rotation meets the great inflation. That's what happens. Prices went up. We'd all finished our home projects during, in those post-COVID periods. That market has slowed. Plus, you've got the housing market in the doldrums. That's really not good news for these companies. That said, Home Depot gets about 50% of its sales from professional customers, but same thing, if you're not putting a new kitchen in, you don't need a workman. So this is a really good proxy for those big ticket items which consumers do cut back on when their incomes are squeezed and they face higher borrowing costs.
Okay, let's see what those numbers are before the bell. Andrea, thank you so much. Our Bloomberg opinion columnist, Andrea Felstad, on all things retail. Coming up, we'll take you through the market-moving events of the day. It's a beautiful skyline in New York. Stocks are lighter as Goldman's upgrade their target on stocks to 5,200 for 2024.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Watching Bloomberg Brief. I'm Danny Berger alongside Manish Kramny in New York. Let's get you set up for your trading week on this holiday shortened week. We're going to get Walmart and Home Depot reporting earnings before the opening bell today. Tomorrow, the Fed releases its minutes and NVIDIA reports earnings after the bell. Then we get U.S. existing home sales and another round of jobless claims come out on Thursday. Manis, we're still living with the trauma of last week, the data of last week, though, of course, both Priya Misra and Paul Donovan still think that disinflation trend or that lower inflation trend is in.
It's interesting. It depends whether you look at it as being trauma or healthy volatility and a repricing. Does it allow you to reload up on duration? You've got a couple of individual stocks that are moving this morning. The U.S. is awarding $1.5 billion to Global Foundries. Now, this is the largest domestic maker of made-to-order semiconductors here in the United States of America. I don't know that maybe it's disingenuous to say it's the poor man's NVIDIA, but we had Nancy Tengler talking about, I think it was Qualcomm as being the poor man's NVIDIA. Intel is up 3.9% this morning. You've got a rating there, a new buy rating by CITIC Securities with a price target of $55. That's double nickel, so $10 above here. And Apple's set to face a €500 million fine from the EU on Spotify, as well as people taking their Vision Pro headsets back to the shops.
Well, the nerves are all around NVIDIA. Let's be honest, Manis. NVIDIA's down about 2.5% in the pre-market. You also see overall stock futures are down today. The fact that Priya Misra said the bond desk that they're talking about NVIDIA, I think says a lot.
They're steady as a rock on those bond desks. They're not like those. They're not like those flighty equity traders. They're hardy boys and girls in the bond market, meat-eating bond traders.
Love it.
Operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
The Fed is beholden to the inflation data.
Even if we get those rate cuts, we're still in a higher interest rate regime.
We know we're going to eventually get some easing. How much easing we're going to get, we're not sure.
It's a hard equation to say they should be cutting rates.
We all have to keep a very open mind about this cycle because there's no real parallel for it.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your week started live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Farrow. Your equity market on the S&P 500 negative here by 0.4%. We spent the last 18 months or so staring at the US economy, waiting for recession and totally missing. The rest of the world is already in one. The UK, Japan, Germany, Bramo, China struggling to make this economy stand on firmer ground.
Given the fact that they cut rates, private mortgage lending rates by the most going back to 2019, and the market shrugged. Basically, no one really cared because it wasn't enough to support the economy. Here is the thing. If you've reached the point where people don't have the confidence in an economy, how do you restart some sort of consumer spending cycle that the U.S. is enjoying ad nauseum?
We've talked about this a few times now, Lisa. They are facing what many people consider to be a classic balance sheet recession. They've got consumers that are trying to deleverage, facing the prospect of lower prices in the property market. Lower rates is not going to solve that problem. The issue needs to be addressed with fiscal policy. Now, whether the Chinese authorities actually want to go down that road or not is the ultimate question this morning.
Which is the reason why you're not seeing a lot of conviction for people who go in because it's a trade, not necessarily because they have conviction and some sort of strength in China. I think it's interesting. There were some job cuts over at some of the miners overnight, and really this sort of speaks to a weakness in demand from places like China that isn't resurrecting. And that's the question. When is it going to, are we reaching a new era where they're not going to support the economy with fiscal?
Yeah, the difference between the United States and the rest of the world is absolutely remarkable right now. The equity market in the United States just off all-time highs, and M&A picking up. Another big deal announced. Capital One agreeing to buy Discover Financial Services, a $35 billion all-stock deal to create Bramo, the largest U.S. credit card company by loan volume. And the first question I was thinking of was, Anne-Marie, you tell me, is this one going to happen or not?
Well, it's a great question because what we've seen from the Biden administration is take on a really robust look when it comes to antitrust deals. In December, we saw that there was actually a record for merger enforcement activity from the DOJ, from the FTC. Biden in 2021 issued this executive order about making sure that there is competition in the market. And you have to look at some of the big names that had to unwind deals. Penguin, and Simon & Schuster, American Airlines, JetBlue. Does this go through? It's a great question.
But here's the problem. Penguin and Simon & Schuster are not exactly, acmes of strength and growth right now. When you talk about Spirit and JetBlue, again, struggling. When you talk about Discover, having some serious issues. So is this really an issue coming from strength, where they want to dominate an industry, or to survive? And this is one of the key questions behind a lot of these deals.
I'll throw in another question, Lisa, and we can have this conversation with Amanda Lynham over at BlackRock on credit. All stock deal. All stock deal. How many times have you woken up on Monday morning and heard all stock deal, not debt?
Never debt. And that, I think, is really compelling. This is not a matter of giving somebody a windfall payout, because, frankly, this debt market isn't allowing it anymore. This is about something else, perhaps survival, consolidation of different types of efficiencies of scale. We saw that with other deals as well. This is what we're looking at right now. This isn't coming from a place of looking to dominate the industry in some sort of new JP Morgan rival type of way.
This is what I'm looking at right now. Earnings, Lisa, from Home Depot. Let's go through them together. I'll give you the fourth quarter comp sales number, negative 3.5%. The estimate here was negative 3.63. This is the outlook for you. This is what they see for sales in the outlook. The outlook of about negative 1% here, Lisa, against an estimate of positive 0.18%. The stock is down just a touch by 1.2%.
Yeah, and talking about fourth quarter earnings per share missing $2.82 versus the estimate of $3.30. But here's what we've been seeing again and again. Boosting their quarterly dividend by 7.7% to $2.25 a share. We have seen this time and again. Even if the sales aren't there, even if the earnings isn't there, the dividends are going to be there, the share buybacks are going to be there. There is a sense of needing to return capital to shareholders.
That's Home Depot. Walmart coming out a little bit later. Let's turn to the broader price action for you. Their stock is down by close to 2%. Equity futures on the S&P 500 negative here by 0.5% on the S&P. The event of the week might not be the data, might not be the Fed speak, may well be, Bramo, NVIDIA earnings after the close tomorrow.
Entirely. Basically, people are saying that this is going to make or break the sentiment for the entire world markets, because this is the fourth biggest company, and it really is the future of everything, because everyone is AI frenzied and crazy. This is sort of the question. How much is NVIDIA one company, and how much is it the representation of the AI fervor that has really supported global markets in a way that many people didn't expect?
Stock up big time again year to date this morning, down just a touch by, let's call it 2.5%. Coming up on this program, Steve Chevron of Federated looking ahead to NVIDIA as the earnings report of the week. Terry Haynes of Pangea Policy with pressure building in Washington to deliver aid to Ukraine. And Bloomberg's Ender Curran as Chinese banks look to backstop the troubled property market. We begin with our top story. It's the earnings report of the week, maybe even the quarter. NVIDIA reporting tomorrow in the latest signal for big tech and AI. Steve Chevron of Federated expecting growth to expand for the Magnificent Seven, saying this: inflation will moderate, cuts will come, and we think that benefits stocks and will eventually support a broadening out of the equity market from the Mag 7 to other less extended parts of the market. Steve, I'm pleased to say, joined us around the table. Steve, good morning to you, sir.
Good morning.
NVIDIA, earnings report of the week or the quarter?
Oh, I think it's the quarter. I mean, look, you've got an earnings season right now that's shaping up to be pretty good. It looks like we're going to do double-digit earnings growth. But if you look under the hood, you've got 40–50% earnings growth coming from tech, tech plus, and the rest of the index is down, or at least flat. Now, if you look at how that's expected to progress over the year, by the time we get to the fourth quarter, if expectations materialize, we're going to have the rest, the 493, if you will, growing at something close to 20%, while the Mag 7 slow to something closer to 10. So that handoff really needs to occur between now and the end of the year for the market to continue on this rally. We think it will.
A lot of people have been saying that we're going to see broadening out for quite a while. We haven't really seen it.
No.
It's been sort of one step forward, 15 steps back. What's going to be the trigger for some sort of shift?
I don't know about 15, but
okay.
I think we are at an all-time high.
Come on, play with me.
I think what you've seen happen is the bond market got ahead of itself, right? When you got in the fourth quarter of last year, and the Fed started to pivot, bond yields started to fall, you saw a broadening out. I mean, it's not that tech did poorly, but the rest of the market really started to gain its footing. But then the bond market got ahead of itself. And so now we're pricing back those cuts. We're pricing in a little stickier inflation. We're pricing in fewer cuts. And you see the market kind of retrenching back into the Mag 7. And I think what you really will need to see is those ingredients for cuts to come through. You need the inflation data to participate, which right now it's not. And you need the Fed to start cutting. We think that starts in June. But we view this as an opportunity to buy into those areas.
So dovetail this with NVIDIA earnings.
Yeah.
Is NVIDIA's gain everybody else's pain, or is NVIDIA's gain everybody else's gain?
No, I don't think the Mag 7 are stealing from the rest of the market. I don't think that's right. I think even when you see a broadening out, we're not expecting, the Mag 7 to be in trouble or to have absolute declines. We just expect those returns to normalize as earning growth starts to normalize and spread out. So, we expect them to be market performers, but some of the other parts of the market that have lagged to start to take the lead.
Been amazing for us to see what's happened in the bond market over the last couple of months or so. We've pushed out rate cut calls. Yields are repricing higher, and it's happening for bad reasons, not good ones. It's not just about the strength of economic data. It's about inflation still running hot. CPI, PPI last week. If you just frame last week, yields up off the back of hot CPI and hot PPI, and then equities down what? 0.4%, 0.5%?
0.42%.
Basically nothing, Bramo. Nothing at all. What do you make of that? Is that a disconnect for you?
Well,
in any way, shape, or form?
Two things. I'm going to make news here and do something I never do. I'm going to praise the Fed. They've been right, I think, in understanding that some of the goods price deflation was transitory and not overreacting in a dovish way. I think in terms of the equity market, when you take a step back to the medium term, John, you have rates that are likely to fall this year. Maybe it's less than the market was hoping for a month ago, but they're still likely to fall. But earnings that are growing, right? We've exited the earnings recession. It looks like we're going to do 10% earnings growth this quarter. How often do you see a combination for equities where you have rates falling and earnings recovering? It's hard to sell off too hard in the face of those two things.
You understand the worry, though. Do you believe that the Fed's dual mandate is coming into conflict after the data we've seen so far, just last week?
I think the labor market right now is still strong, and I think inflation is stickier than maybe some folks would have thought. So, yes, it's higher for longer, if you will, but again, from our perspective, we think it's still 2 to 3 cuts this year. It's not 0. It's not the 6 the market was trying to price in. 2 to 3 cuts with earnings growth that's accelerating, that's not a bad environment for equities.
Why is it that you're optimistic about small caps when there seem to be the most leverage to rates?
Yeah, because again, in the short run, when you saw 6 cuts priced into the marketplace and you realized that indigestion was likely, that was our call. I think I was here in January saying the same thing. You can see some downside opportunities there, right? On small caps, on cyclicals. However, if you're a long-term investor, if you're a medium-term investor, and you think that the end state here is in fact rate cuts and earnings growth that is reaccelerating and a recession that's not going to materialize, well, small caps are also leveraged to not going into a recession. They're also leveraged to rates eventually falling, considering more of that debt's variable rate. So we're looking at this and saying, if folks want to throw the baby out with the bathwater, we'll pick it up over the next couple of months, build that position, and we think benefit when rates fall.
So let's talk about the babies. Right now, we're seeing Home Depot lose a little bit because the Home Depot CEO calling 2023 a year of moderation, and they came out with a lower forecast than people had expected. Where are the babies? How do you find them?
Well, I think what you're looking for here is look at the equity market for a second relative to the bond market. The most expensive parts of the bond market are those that are most leveraged to growth, right? Think about high yield and how tight spreads are. Look at the equity market. The parts of the economy that should benefit from a recession not materializing and should benefit from rates eventually falling are cyclicals, it's small caps, it's dividend payers. Those have been the parts of the market that are the cheapest. So again, if you're trying to take a contrarian tilt, which we think you need to do here, you use the weakness in this delay of rate cuts to build positions there, and we think you're going to benefit on the other side.
Elisa, what do you make of that line from the Home Depot CEO that you just mentioned? The year of moderation was 2023. Given the growth we've just had, what would you call 2024?
Exactly, given the fact that we had, 5% growth?
In the third quarter,
in the
not
third
bad.
quarter. I mean, this isn't exactly moderation according to any kind of standard. I'm trying to wrap my head around how much this is specifically a home renovation story and how much this is a broader story. And I'm curious to hear on the call what they speak to with this, how they view the commodity disinflation that they saw to some degree, but also the fact that people were sick of renovating their homes after they'd done that ad nauseum because they couldn't move during the pandemic and they got sick of their walls.
Speaking for yourself here?
No, just...
No, not at all. Of course not. Of course not. We'll be following that and the Fed speak, of course. Just a speaker from the Bank of England, Megan Green, longtime friend of this programme over the years, saying the risk of cutting too quickly and then reversing. The risk of cutting too quickly and then reversing. I think that's not just a problem for the Bank of England. Lisa, that is clearly something that weighs on Federal Reserve officials as well.
They've been talking about this. We heard that from Mary Daly last week. We heard that from a host of others. This is the reason why people are pushing out their rate-cutting forecasts. At the same time, is this that people are changing their forecasts or just taking off the tail risk of recession? And that's the difference. If people are saying they're not going to cut rates nearly as much because they're worried about sort of reignition of inflation, that's going to be potentially more damaging than just saying we're pricing out the case of recession.
Have you seen the mini-Fed meeting taking place on Thursday? Jefferson, Bauman, Harker, Cook,
Yes.
Kashgari, and Waller all
I thought of you. Yeah, it's going to be really great. But they're going to be speaking past each other because I don't think they're going to be speaking at the same event. So they can kind of, you know, if they have an issue with somebody, they can kind of angle their
for their own opinions.
Yeah.
The Fed Minute's coming later this week as well, so you'll get plenty of Fed speak. Equity futures on the S&P 500, negative here by 0.4%. Steve Chevron is going to be with us through the next 15 minutes or so. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Russia's war with Ukraine is nearing its third year. This morning, the Ukrainian Air Force says it shot down all 23 drones and missiles fired from Russia overnight. A regional governor says 3 people were hurt. Meanwhile, President Biden says he's be willing to meet with House Speaker Mike Johnson to discuss stalled aid for Ukraine and Israel. Biden says the death of jailed Russian opposition leader Alexei Navalny adds to the urgency of the moment. Shares of Barclays are gaining in Europe this morning. The British bank is going on a major cost-cutting drive and returning billions to shareholders. Bloomberg reports that Barclays is overhauling its operations and reorganizing into 5 new divisions. Those will consist of a UK retail bank, a UK corporate bank, a private bank, a wealth management arm, an investment banking division, and a US consumer bank. China, meanwhile, is ramping up its support for its troubled property sector with its biggest cut ever to a key mortgage reference rate. The PBOC announced that lenders will slash their 5-year loan prime rate by 25 bips to 3.95%. It's the country's first cut since June as policymakers tried to relieve China's property crisis. And that is your Bloomberg Brief, John.
Hey, Danny, thank you. Up next on this program, President Biden turning up pressure on House Republicans to pass aid for Ukraine.
We're making a big mistake not responding. Look, the way they're walking away from the threat of Russia, the way they're walking away from NATO, the way they're walking away from meeting our obligations.
That conversation coming up next, live from New York City this morning. Good morning.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Live from New York City this morning. Good morning to you all and welcome back to work stateside after the long weekend. Equity futures on the S&P 500 negative here by 0.4%. Yields going absolutely nowhere. 427.33. Under surveillance this morning, President Biden turning up pressure on House Republicans to pass aid for Ukraine.
They're making a big mistake not responding. Look, the way they're walking away from the threat of Russia, the way they're walking away from NATO, the way they're walking away from meeting our obligations, it's just shocking. I've been for a while. I've never seen anything like this.
Here's the latest this morning. President Biden saying he's willing to meet with House Speaker Mike Johnson in order to pass the $95 billion foreign aid package stored on Capitol Hill. Pressure is building to pass aid for Ukraine following the death of Russian opposition leader Alexei Navalny in a remote prison on Friday. Terry Haynes, founder of Pangaea Policy, joins us right now to talk about exactly this. Terry, let's get straight to the president's response to this, or lack thereof. Does he, in your mind, in your opinion, continue to project weakness to the rest of the world?
I think on Ukraine, John, he has done for quite a while. I mean, you can, I take my inspiration this morning, as many mornings, from the Bloomberg website, and what I get is I get one of your columnists talking about the ineffectiveness of Russian sanctions. Part of my point has always been that they're badly enforced, if at all, combined with late provision of weapons or no provision at all, and on top of that, a lack of being able to use all the tools of the presidency, including the Defense Production Act, to top up stores for both the United States and for allies. And what I get is somebody that has, claims to be as forcefully supportive for Ukraine as possible, but in fact is not being. All I'm suggesting is not a partisan point. I'm suggesting this is a whole of government problem, not just a Democrat-Republican problem.
If he says he's ready to meet with Speaker Johnson, could that mean there's a path for Ukraine aid to get passed in Congress?
I think there's plenty of path for Ukraine aid to get passed in Congress. My basic point on this has been that, process aside, and Washington people love to talk about process, in part because it's easier than talking about substance, is that, and makes us all feel smart too when we're doing it, is that 3/4 of the House is in favor of Ukraine aid, and I could justify that 5 different ways. But 3/4 of the House is in favor of Ukraine aid. It is much more likely than not that this happens. There are a variety of processes to make it happen, from a discharge petition to a suspension calendar to even regular order. But I do think it's likely. Back to John's point, though, I will point out something in Biden's statement that you just gave me. He's willing to meet with Speaker Johnson. Well, why doesn't he demand that Speaker Johnson come on down and sit in the Situation Room and, let's really talk turkey? Why, energy in the executive, which is what's needed here, means you need to force the issue. I don't see a White House trying to force the issue here.
Well, Tina Fordham of Fordham Global Foresight over the weekend was talking about the role that the former President Trump plays, saying, is he more than a president in waiting? Is he some sort of second president? The House Republicans, at least the Speaker of the House, are too worried to call an up and down vote on U.S. aid to Ukraine, because if he did, it would pass. And this is something that really needs clarifying. Is all of this being held back by the fact, Terry, that a lot of Republicans face primaries even before November's presidential election?
Yeah, well, the way I would put it is, I think it's very easy to talk about Trump's hold on the party and all the rest, and I'm happy to dispute that to some extent elsewhere. But the way politicians think is they're thinking in terms of their own bases. Part of their own base, and many Republicans certainly, feel that what they need to be doing is providing aid to the border first, and rationalizing the border before they get to any question about foreign aid. Whatever else that is, that's a defensible position. But this is a political reality that nobody's attacking right now. Everybody's staying in their corners, not trying to reach consensus, or more importantly, force consensus until somebody actually does. This Ukraine aid situation is going to be tough sledding.
Terry, there was some speculation over the weekend that the death of Alexei Navalny would turbocharge or sort of restart some of the talks and put new urgency behind aid to Ukraine. Do you buy that at all?
No, sadly, I don't. Mr. Navalny's death, among other things, I think is actually not very much of a surprise, firstly. Secondly, the United States foreign policy always gets into trouble when we're rationalizing on the basis of somebody's death. I mean, you can look at Jamal Khashoggi for a rough example of this. The reaction from Biden was to Khashoggi's death was Saudi Arabia was a pariah, and then we were fist bumping with Saudi Arabia, and then we were talking to Saudi Arabia about post Middle East conflict, where we were going from there. Yeah. Now I'm not quite sure where the administration is, but it's Navalny's death is not the problem here. Lack of understanding and willingness to do something about the geopolitical situation is.
Terry, I wanted to squeeze this in. Capital One, Discover Financial Services arriving to the dance party. They want to make something happen. Does this administration let them?
The problem here is that, let me just put it this way, without looking at the merger in great detail. The problem is that the regulatory authorities tend to see 4 weak competitors as somehow preferable to 3 strong ones. And both of those parties, I think, and anybody that's trying to do this more broadly, needs to address that, get over that hump pretty quickly, because what's going to happen is people that don't want the merger to happen are going to use that as a rationale for making it stop.
Hey, Terry, good to hear from you. Appreciate the opinion. Terry Haynes there of Pangea Policy with us around the table still. Steve Chevron of Federated. Steve, what do you make of that? Not the specific deal, but just the attitude of the regulator to deals like this one going through.
Well, yeah, I mean, look, you're not seeing excess, I think, in the M&A space, just like you're not seeing excess in the IPO markets right here. And so I would agree with what Terry had to say, which is if you've got a couple of weaker competitors that are trying to get together for strategic reasons for survival, I think you need to look at that closely as a regulator. And in addition, I mean, look, regulators haven't minded the duopoly between Visa and MasterCard. So I don't understand why this is, would be a huge issue. So, I mean, I'd hope they'd be able to see past that.
I guess another way to ask this is, how much do you buy this type of transaction announcement at its face value, that it's something that can go through? Is there sort of a threshold for the value of a deal that you can get behind and invest in versus one that you say is too subject to regulatory scrutiny?
Well, I think you're gonna see that in the stock reaction, right? I mean, you're gonna see, how much of that kind of that takeout premium is priced in, and how much of an uncertainty discount is in there. We'll have to see kind of how the names open up and trade over the next couple of days. But I do think, generally speaking, you've got more regulatory uncertainty here because you've clearly had, politics not involved, an administration that has not been overly friendly to M&A activity, as Anne-Marie mentioned earlier.
Final question for you before you run. From here until year end, equal weight S&P or market cap weighted S&P?
No, I think it is equal weight. I think you're building that position over a period of kind of Mag 7 dominance between now and that first rate cut. We think that rate cut is probably more of a June event than a kind of May event. And then we think you benefit from that in the second half of the year. If you don't, John, that means something went wrong.
Interesting. Steve, thank you, sir.
Thank you.
Good to see you. Steve Chevron there of Federated. Brahma, we talked a little bit about this last week, that maybe the data and the repricing of rates shocked the market more than it shocked the Federal Reserve. Steve's here sitting in line with the Fed basically saying 2 to 3 cuts for 2024 and still basically saying this equity market can do okay.
What's interesting to me is so many investors and analysts who've come on the show say that actually they've always been pricing in 2 or 3 rate cuts, that they've never thought about 6 rate cuts. It was that tail risk of a potential recession that was creating that.
That was someone else.
That was someone else, and they were worried about that, but it wasn't me. It's pretty much everyone, which basically means the tail risk has been taken off the table, so let's go.
It wasn't Steve. It was someone else. Coming up on this program, Home Depot earnings and a look at the U.S. housing market. From New York City, you're watching Bloomberg TV.
formed a partnership with Penny Pritzker at some point to do parking. Is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, well, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Live from New York City, good morning to you all. Here's the price action. Equity futures pulling back on the S&P, on the NASDAQ 100. On the Russell 2, we're down about 0.4% on the S&P 500. On the NASDAQ, down by 0.6. Coming off the back of a very, very minor week of losses on the S&P 500. In the face of a real repricing again in the bond market. Let's go to the 2-year, the 10-year. We're talking about double-digit moves again on the week, and yet this equity market was down not even by 0.5%. This morning we're down 2 basis points to 461.64. The 10 years at about 427.72. But Lisa, this wasn't on really strong retail sales. That was weak. This was off the back of hotter than expected CPI and PPI, which arguably is pushing out rate cuts for the wrong reasons, and yet this equity market was still okay.
People looked at the retail sales. They said, it's seasonal. How many people just shrugged it off? And they said that that's not indicative of weakness coming down the pike. It seems like people are completely repricing out the chance of any kind of recession. No one is calling for recession right now. Maybe weakening growth, perhaps, but it's going to be Goldilocks at the same time that you're going to see some of this hotter than expected inflation cool off just a bit. What I find interesting is it is the perfect world for stocks. It is not the perfect world for bonds. How long can that continue before you get some sort of reckoning between them?
That's the ultimate question, and the thing that you and I have been focused on now all year. When you push this through the FX market, it's pretty clear what's going on. Dollar stronger, 5 consecutive weeks of it. The euro a little firmer on the session to 107.94. Let's go through it. The US economy is still okay. Jobless claims dropped lower last week. Based on that, the labour market's standing up to global weakness. Let's put it that way. The UK in contraction. Germany in contraction, arguably recession, if you listen to the latest comments from the Bundesbank. Japan in contraction, in recession. China, deflation, a slumping property market. Strip the US out of the equation, and we'd be talking about a dreadful global economy, a global recession.
Which is the reason why maybe we're not seeing oil prices respond to some of the geopolitical risk, because of maybe a lack of demand from other nations that are more industrial, like China. Here is the question. Can the U.S. remain in its own kind of bubble? Everyone who we asked last week basically said, yes, it can. And the reason why? Partly the fact that consumers keep spending, and oh yeah, they're spending with fiscal stimulus that keeps getting pumped into the system. And that's been sort of a defining feature of the U.S. recovery, was the helicopter money that we talked about during the pandemic.
And seemingly that's what China is reluctant to do. We'll talk about China in just a moment. Under surveillance this morning, our top stories. President Biden's top Middle East advisor, Brett McGurk, will travel to Egypt this week for talks ahead of a possible Israeli assault on Rafah. Israeli Prime Minister Benjamin Netanyahu vowing to push ahead with the operation if hostages held by Hamas are not returned by the start of Ramadan. The Biden administration telling Netanyahu to plan for the evacuation of civilians in southern Gaza. More than 1.4 million Palestinians have sought refuge in the area since the war began. And Marie, things are getting more and more tense day after day.
They are, and I would actually point to this draft resolution Bloomberg has seen from the United Nations. So the U.S. is going to be calling for a temporary ceasefire. This is something they've really been reluctant to do, and I think it just shows how gap their thinking is growing with Benjamin Netanyahu and how frustrated President Biden is with the Israeli cabinet.
But I'm curious how much teeth there is behind this. Is this sort of catering to certain constituents, or is this actually some sort of push to try to get some ceasefire. A real reason it's hard to know.
There's also one line in this draft text, and at the moment it's just draft, but it says such a major ground offensive should not proceed under current circumstances. I think that gives Netanyahu some wiggle room.
To Lisa's point, is this really about international concerns for Biden or about domestic issues going into the election?
I think it's about both. On one point, they do want to make sure that they put a lid on what is going on in the Middle East. Look what happened to that vessel, the Houthis say, has sunk over the weekend. This is the first time that's ever happened. But domestically, massive amounts of pressure in this administration. Look at Michigan. There's a group that voted for him that now has abandoned Biden. And you're dealing with small fractions of the electorate in key critical states.
That's the latest on foreign policy. Let's turn to our next story. This one here. Capital One agreeing to buy Discover Financial in what would rank as the biggest global deal of the year. The $35 billion all-stock agreement would create the largest U.S. credit card company by volume. Capital One will pay a 26.6% premium to Discover's closing price on Friday. The deal is expected to be completed by the end of this year or the beginning of 2025, pending shareholder and, drumroll, Lisa, regulatory approval. I think that is the big one right there.
Especially given the fact that Spirit and JetBlue was stymied. You've seen this time and again. This is not an administration that's particularly friendly to big tie-ups. But we've been talking about this all morning. These are not tie-ups of great strength behemoths. This is a tie-up of two companies that feel like they could be a whole lot stronger together and that might be facing some issues, particularly as Discover, without this kind of a deal.
I look back at the Consumer Financial Protection Bureau's recent report, though, and I think regulators will hone in on this. Research has found high-level concentration evidence of practices that imply anti-competitive behavior in the consumer credit card market. As we noted in 2023, top 30 credit card companies represent 95% of credit card debt. The top 10 dominate the marketplace. This will clearly be, and they already are, in the top 10. But what I'm saying is an administration that already has not looked friendly on these massive tie-ups and mergers are going to go to data like that to prove their point.
I also just wonder, from a financial point of view, Capital One is one of the biggest subprime auto and other loan lenders, right?
Yep.
If someone wants to cater to lower-income families, this is the one that you want to continue to exist and thrive, right? So is this a way to allow them to keep making those loans while getting those prime customers through Discover? That should be a positive. I mean, there are all sorts of arguments for why this should go through. It's just fascinating to me, like we were talking about, that A, this is going through not from a position of strength, and it's an all-stock deal. Whether it actually gets through, I'll leave that to you to discuss.
Let's just sit on the all-stock deal, just for one extra beat. Isn't it kind of funny that the credit card company is financing the deal with equity and not debt? It's like, do as I say, not as I do.
I love that point. That's great. I mean, honestly, why would they want to pay the 25% that they charge?
Well, clearly they don't.
Yeah, exactly.
Which is why, first thing I thought about yesterday when I saw the reports on this. Let's get to this story here. China ramping up support yet again for its troubled property market. Banks are slashing the 5-year loan prime rate by 25 basis points to 3.95%. This marks the biggest ever cut to a key mortgage rate. Lenders are looking to reduce minimum mortgage payments and boost demand for falling apartment prices. Investors in China also looking for signs of stimulus ahead of the National People's Congress early next month. Lisa, good luck. I mean, we've been waiting for this for quite a while now. The reopening, go back to, say, more than 12 months ago. China's going to reopen, the economy's going to boom. Just didn't happen. Hasn't happened. Isn't happening.
It reminds me of, literature class in college with Bertolt Brecht and Waiting for Godot and this sort of question of when are they actually going to come to fruition at a time when it doesn't seem like they want to go that route. They also are not giving consistent policy signals with respect to welcoming in international businesses and investors. So at this point, is there a clarity of message? Or is this a clarity of messaging of what they want to get across? And frankly, this market's not buying it.
You see the latest FDI data?
Yeah.
It's just dreadful. Turn that around.
But I mean, why would anyone want to invest in there? I mean, really, the most bullish people get is it's a good trade because it can't get much worse. That is the most optimistic that people can get about going into China.
Policy just became increasingly unpredictable, and then even more unpredictable. That's the latest on China. Here's the latest on earnings this morning. Home Depot kicking off a busy week of retail earnings. The company reporting a 5th consecutive quarterly decline in revenue on weak demand. Comparable sales fell 3.5% in the fiscal fourth quarter. Home Depot also announcing it's boosting its quarterly dividend by 7.7% to $2.25 a share. Drew Reddick of Bloomberg Intelligence joins us now with more. Drew, let's just go to the headwinds. What are the headwinds right now for this company, and do you expect them to last through the rest of this year?
Sure. So we do think that the environment for the consumer is going to remain challenging through a lot of this year. One of the things that's unique to the home improvement market is that we're still battling a massive pull forward in demand during the pandemic. if you look at the share of personal consumption on goods, you're seeing a reversion to the mean. And if you look even a little bit deeper and look at the portion of personal consumption expenditures related to home improvement specifically, you'll see there's been a pretty sharp drop since peaking early in 2021. So we think that there's a little bit reversion left for the industry as a whole. But in the meantime, you know, the consumer is stretched. You see personal savings rates down a little bit, credit card balances are rising. So the challenges are still there. At the same time, we're looking at housing transactions that are the lowest since the mid-90s. You know, if you play it out a little bit forward and you do start to see rates start to moderate, you could see a rebound in existing home sales, which would help the home improvement space heading, you know, towards the tail end of this year and into 2025.
Drew, there are 2 points there, and it's important to distinguish between the two. There's one where consumers are getting tired and don't have the cash and are getting stretched given the credit card bills and others. And the second thing is just there's been absolute stasis in the home buying market. This is the question. If rates come down and you do get more transactions, does it matter that the consumer is this stretched, or is this really just an issue about transactions?
I do think it matters. I mean, if you look historically, there's been a pretty strong relationship between spending on home improvement projects and moving. And it stands to reason as you move, you prepare your home for sale, you take on certain projects. Same thing when you purchase a home. You make those improvements after the purchase. We've seen data suggesting that movers spend about 2 times more than someone in their home who is not moving. Now that relationship has broken down a little bit over the last couple of years because you've had people who are disincentivized to move because they had such a low rate on their current mortgage. You also had the pandemic factor where people were investing more in their home because it took on such a more important role. So that relationship has disconnected a little bit, but we do think that it will resume as we get later into 2024. We do think that a rebound in existing home sales, even though we don't expect them to normalize by any means at this point, we do think it will provide a tailwind.
John, did you hear that? It wasn't just me. He said that basically, you know,
everyone was talking basically to you.
It was like if you're locked in
3%
and you're
mortgage,
exhausted by some of the same walls again and again. Drew, I mean, honestly, here's my question. Is this sort of an idiosyncratic story about home building and home renovations, or is this a broader economic story about the ability for consumers to spend? You're saying that it's a bit more of the latter than some people would say.
Yeah, I mean, I think it's both. I do think that the consumer is under greater pressure. And at the same time, I think that the home improvement industry has some unique factors going on because they're so tied to what's happening in the housing market. And, you know, as we've seen over the last year and a half, housing is just frozen at this point, and transactions are completely depressed. And we think that keeps a lid in the near term on demand.
Drew, good to hear from you. Drew Running there of Bloomberg Intelligence. You do wonder, Bramo, we've asked this a few times, do a couple of rate cuts make a difference to this story?
They did, though, in mortgage applications. That's the weird thing. When you saw rates go down about 0.5 percentage point, you saw suddenly mortgage applications shoot upwards. So what's that threshold? Is it sort of a psychological point of 6.5% or 6% on a mortgage rate? I mean, really, if you think about it, doubling where it was when some other people got their mortgages, that, you know, it's that you can understand why people might get sticker shock.
It's like having the new Lamborghini on the drive. I was saying this to Tony Dwyer of Canaccord a number of months ago because he casually drops in that he has a 3% mortgage. And there's the biggest brag in society post-pandemic.
Humble brag.
Nothing humble about it. You just sort of drop in, you got a 3% mortgage.
I didn't say that I did.
You basically tell us every week now.
Well, it's okay.
I need rates down 400 basis points and prices to adjust in Manhattan by something like 35%.
Okay, well,
and that'll start to grease the wheels.
For you to get out there and do this.
Just a little bit.
You know, but this is sort of the question. How many rate cuts actually matters if the economy's good? I mean, if you end up, you know, I don't know, getting promoted. Where would you get promoted to? I mean, but like this is
me a promotion.
You know, like, but if you start earning more in this society, then you could, you know, afford it.
I think I've got my annual review a little bit later this morning, so you can come to that with me.
Sure, I'll be right.
We can talk up what it would take for
you to actually be able to buy an apartment, given mortgage rates. I'll prepare you a spreadsheet.
Great, I can't wait.
This is great.
I'm sure my manager's going to love reading that. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Bayer plans to slash its dividend by 95%. It's an effort to dig itself out of a hole created by the acquisition of Monsanto. Bayer says it will offer investors only the legal minimum required under German law, paying out 11 euro cents per share for 2023. The company has faced thousands of lawsuits claiming that Roundup weed killer causes cancer, which it denies. Bayer has already pledged to spend as much as $16 billion to resolve the litigation. Russian President Vladimir Putin may be violating UN sanctions with his latest move to boost ties with North Korea. According to state media, Putin gave North Korea leader Kim Jong-un a brand new car. A Kremlin spokesman says that it's an Urus, a Russian-made alternative to Mercedes. Luxury vehicles are on the UN Security Council's list of banned items for export to North Korea, but there's little the council can do to punish Putin. California is still grappling with extreme weather and another atmospheric river. The National Weather Service warns of difficult conditions through Wednesday after an expected lull today. LA and San Diego are at risk for significant flooding with 5 inches of rain predicted for some areas. The storm is expected to pass through quicker than the one earlier this month. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this program, China ramping up support for its property sector.
On balance, it's a positive. Yeah, it's bigger than market expected, and the market also looking for a cut more on the 5-year. Overall, it's a positive, and I should help, but it's not going to change the big picture.
That conversation with Enda Karen just around the corner, live from New York. This is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Stocks are negative here. We're down about 1/3 on the S&P 500 in the bond market. No drama here. Yields going absolutely nowhere. 427.53 on a US 10. The euro is just a little stronger. 108 on euro dollar, positive by 0.2%. Under surveillance this morning, China ramping up support for its property sector.
Sales came down a lot in housing, but the price actually need to fall more to clear the inventory. Either the government set up some state fund to buy over some of the project, or some of the stronger hand have to take over many of those projects and get them built and deliver. On balance, it's a positive. Yeah, it's bigger than market expected, and the market also looking for a cut more on the 5-year. Overall, it's a positive, and I should help, but it's not going to change the big picture.
Here's the latest this morning. Chinese lenders slashing their 5-year mortgage rate by 25 basis points. It's the first cut since June and the largest on record. The move marks an intensified focus on combating the country's widespread property crisis. Joining us to discuss is Enda Karen, Bloomberg Global Economy reporter down in Washington, D.C. And let's start with a downturn in China. Do rate cuts help, or do they need to do something much more targeted on the fiscal side?
Well, I think, look, it suggests some urgency by the policymakers in Beijing, John, moving the LPR by the scale that they have, 25 basis points. That will obviously help mortgage holders, help people get in the market there, and of course, perhaps at the margin start to turn things around. But as you mentioned, the entire world has been looking towards China over the past year or so, wondering when will they start to turn around the real estate sector. And I don't think this move in and of itself will be enough to do that. You saw the market reaction pretty muted. You hear what economists are saying in response to it as well. A short-term, cuts to the near-term money market rates won't be enough to turn it around. It's going to require a much bigger bang-style approach, I think, from the authorities to get the real estate sector back on its feet.
And we've been talking about this for a while now. In your experience, your coverage of Japan all those years ago, are there echoes of the balance sheet recession that plagued Japan playing out in China currently?
Well, that's one of the big talking points between China and Japan. Debt, however, does continue to grow in China, John. That's one of the key differences when it comes to that debate. China, no doubt, is battling deflation right now, though, and it's in a much worse position than it was, we'll say, this time last year when people expected that post-COVID rebound. And that's been one of the big surprises, I think, for the whole world when you're looking at China at the moment. It's just not just that it's in a slump, but it's how long it's taken the authorities to kind of intervene and take the kind of big steps or big measures that would once have been expected by China to turn that around. And it's feeding this narrative that maybe the authorities are now more focused on, we'll say, on the security side of things rather than on juicing growth the way they once would have in the past. And by the way, we just had a Chinese New Year holiday, and the readings that were pretty mixed as well, suggesting that things in China are still fairly subdued. We do have the NPC coming up. That's the all-important gathering of the officials in March. That will give us the next big readout on where the Chinese economy might be going over the coming year.
With the Lunar New Year, I did notice that the number of travelers, though, to Hong Kong surpassed what we saw pre-pandemic. Are Chinese travelers spending more domestically than they were internationally?
Well, so the travel did rebound, Anne-Marie, over the New Year holiday, both domestically and into Hong Kong and down to Singapore as well. But the spending did not rebound. A fairly mixed picture on that. Goldman and Nomura did an analysis on that, suggesting that actually the spending remains below the pre-pandemic level. And it speaks to the idea that there might be some recovery at the margins. People are starting to get on the high-speed train again or getting a plane to go around to some of these countries that offer visa-free relations with China, but they're not spending the way they were in the old days. So this goes back to the idea that the animal spirits in China remain subdued. There's no real sign yet of a turnaround. And even with this move that we saw last night with mortgage rates, nobody expects that to turn things around either. But the big question is, when will the authorities pull the levers that do inject confidence into the world's second biggest economy? And it doesn't feel like we're there yet.
Also subdued was foreign direct investment, the lowest level we've seen since 1993. Do you expect this to continue given all the geopolitical concerns regarding Beijing?
Always tough to get a very clean read on FDI data because you can slice and dice it in different ways. But I think broadly speaking, Anne-Marie, there's no doubt that investor sentiment towards China is in a much more negative space than could have been possibly imagined even a few years ago. Even if multinationals are not pulling out of China, neither are they expanding or necessarily growing their investment there. And we hear continued warnings from the chambers of commerce representing the big industrial nations about, their members not necessarily being gung-ho on further investment into China. Of course, money continues to go in. Of course, it goes into pockets. But there's no doubt geopolitics is weighing, and that is forcing companies to look elsewhere. And that's why money is going to other economies now, like, say, Mexico, Vietnam, your Poland's and Morocco's. They are gaining when it comes to how geopolitics is impacting the flow of money around the world.
There's a real question, Enda, of what kind of stimulus they could do, fiscal stimulus, that could really reignite some sort of growth, optimism at a time where they've got enough bridges to nowhere, enough villages that are empty, and a shrinking population. What are you looking at in terms of fiscal stimulus that could actually do something with respect to bolstering confidence and growth?
I think measures that would really rev up the real estate sector is probably the one, because it's such a multiplier in that economy. Economists, you can argue the difference, but maybe say between 20 and 25% of overall activity comes from the real estate sector. So if they can go in there, Lisa, and either clean up the banks or clean up the property developers and inject capital into that side of things, I think, you'd hear a lot of people say that China's economy would start to turn around fairly quickly, given the vested savings that there are among homeowners in the real estate sector. That would start to turn the ship around. As I say, we do have this big gathering coming up in a few weeks in March, the National People's Congress. That's where we get the readout on the growth target for the year ahead. and we'll get the readout on what they plan to do in terms of government spending, borrowing and spending. And I think there will be a lot of focus on within that, what are they going to do about the real estate side of things?
I was struck by Anglo-American, the British company, the miner, that came out and said that it was cutting 3,700 jobs because of some of the declines in precious metals and other costs. I keep wondering how much this is directly related to China, how much a lot of the commodity sector has been suppressed simply because China has not been there as a source of demand. From your point of view, how much is that really the story, that the commodity sector is a read on the weakness and lack of building in China?
Well, this is a confusing one because, Lisa, on paper, you know, I totally agree with you. That's what the textbook 101 would suggest. But through all of China's slump last year, iron ore held up. Iron ore at one point was trading over $100. I don't know what it's trading at the moment, but you know, 101 used to be where iron ore went, China's economy was going, but it's held up. So it speaks to the idea that there is investment going on, commodity demand investment going on parts of China's economy. They are spending on infrastructure, especially at the local government level. For sure, it's not the kind of gangbusters commodities boom driven boom by China that we've known, say, over the past couple of decades. But there certainly is demand, and I would point to iron ore as one area whereby China is sustaining that market.
And can we just finish on the compare and contrast with the rest of the world? We've got a downturn in the UK, in Japan, in Germany, and elsewhere. How different are those stories compared to what is playing out currently in China?
I think some differences. I mean, remember, post-COVID, China is disappointed. I think, as we say, John, a lot of there is geopolitics and the real estate sector. UK and Germany, of course, have been on the brunt, I think, of the energy spillover from the impact of the war in Ukraine. That's been part of the story there. There are different idiosyncratic factors, but, you know, no doubt weighing all of this, I will say, is the geopolitics, is the idea that the world is a much more fragile and tense place than it was, say, a decade ago. And I think that is keeping a lid on activity in some of these industrial-led export nations, John.
And thanks for your response this morning, buddy, as always. Bloomberg's Ender Curran there on the latest in the global economy, China specifically and elsewhere. You add it up, idiosyncratic or not, Lisa, it adds up to a global downturn.
Especially given the fact that the only source of growth is the United States. And a lot of people are expecting the great moderation that was 2023 and 5% GDP growth in the third quarter to actually be moderation later this year, which is a reason why the Fed will feel comfortable enough to cut rates.
I think it's fair to say it's the great moderation for the Home Depots of this world.
100%.
And maybe not for the broader economy, with unemployment still sat at 4%.
Which is part of the reason why it's been so difficult getting your arms around this. Home Depot might be struggling. Hermes scarves, maybe not.
Better than good. We'll see if Walmart's doing okay in about 5 minutes' time. Coming up on this programme, Sam Stovall of CFRA, Joe Feldman of Telsey Advisory Group on the latest in retail, Liam Mallett of ExxonMobil, a conversation you do not want to miss, and Amanda Lynham of BlackRock, that and a whole lot more. The stage is set as follows, going into the opening bell a few hours from now. Equity futures on the S&P 500 pulling back by 1/3 of 1%. Yields are going absolutely nowhere, 427.72. This week, a sprinkle of economic data, a ton of Fed speak, and the #1 earnings report of the quarter. Tomorrow, after the close, Nvidia, just about 36 hours away. This is Bloomberg.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
things like solar or wind, it's nice and environmentally friendly, but really is not going to be produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
Was going to keep bringing World Cup. This is a 3 as the economic picture covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Fed is beholden to the inflation data.
Even if we get those rate cuts, we're still in a higher interest rate regime.
We know we're going to eventually get some easing. How much easing we're going to get, we're not sure.
It's a hard equation to say they should be cutting rates.
We all have to keep a very open mind about this cycle because there's no real parallel for it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market pulling back just a touch on the S&P 500. Let's pick out a single name, a rather big single name. NVIDIA, year to date before this morning, up by 46.63%. We're only, 6-7 weeks into this, Lisa, after a massive move last year.
Why not buy it? It seems to be the sort of feeling right now because not only do they beat, but they'll beat by 10, 20%, maybe 30%. I mean, go figure. Here's a question. What's going to be considered a beat by NVIDIA when it reports tomorrow? Is it going to be just simply getting above the expectation on the street, or is it going to have to be smashing it out of the water like they've done a couple earnings in the past?
You've got to beat by double digits and raise.
Exactly.
And then beat by double digits and raise. And this market's priced for that, isn't it?
I mean, basically, you're looking at the 4th biggest company by market capitalization in the world that has gone from a company that nobody's heard of to basically the entire market. So here's a question. How much does it really shift the narrative single-handedly versus just be sort of in an echelon of its own that people can look past?
And do you think it de-emphasizes the importance of monetary policy? I mean, let's get into that a little bit more, because based on what we expected to happen, let's go through it. Data comes in hotter than expected. CPI, PPI last week. Yields are just higher again for another week. I think 3 weeks at the front end of the yield curve, and yet equities are doing okay. Got to wonder why. Is it about monetary policy, or maybe it's not at all? Maybe it's all about the earnings of some big powerhouses like this one, Meta, another one, which is just powering this equity market higher and higher.
Well, that's what David Kostin over at Goldman Sachs was saying, that basically this is entirely an earnings-driven story, which is the reason why he's revising upward his S&P forecast for this year, for the second time since November, to 5,200. That's only an upside of 3.5%. So how much further can you potentially see some of these forecasts go? Here is the issue, though. Can this market hinge on the gains of just a few behemoths, or do you have to see a broadening out? I mean, this sort of goes to a question of, at what point do other companies benefit from the AI boom by creating efficiencies, et cetera? I mean, is this basically a pipe dream that's 2 years out, or is this going to be something that we're going to see monetized the next 6 months?
Walmart numbers just dropping across the Bloomberg. We'll go through the headlines in just a moment as we chew over them. I just want to bring up David Kostin. David, let's catch up soon. Let's go through these numbers.
Please.
November, the price target, 4,700. December, new price target, 5,100. Let's wait a couple of months and see how this plays out, Bramo. New price target, 5,200 over at Goldman.
And it's entirely on earnings, basically saying that they're coming in better than expected. 79% of companies have beat expectations so far on the S&P that have reported. Again, though, you have seen this dominated by the big tech players. You're not seeing it to the same degree in some of the small caps, which is the reason why it's been a tough sell. And you see that time and again.
So let's get to the numbers from Walmart. We can deal with the results, the outlook, and there's a deal in the mix as well. So let's deal with the results first. Fourth quarter revenue, $173.39 billion. The estimate, $170.66. Adjusted EPS for the quarter, $1.80 against an estimate of $1.65. A deal, Lisa, that we can talk about in a moment, but let's go to the outlook as well. They see 2025 adjusted EPS of $6.70 to $7.12. The estimate, a little north of $7.
So they're beating expectations, but I'm curious about exactly why. And we're going to dig through exactly whether this is because of better pricing power, whether this is because of what you're seeing from lower-end consumers. I'm also interested in this Vizio deal. And we're seeing Vizio shares jump 13% in response to this offer from Walmart. This is a television production company, right? This is basically a company that designs and sells TVs, viewer data, advertising. What is Walmart looking to do right now? I'm curious, is it more interested in the hardware, or is it about the data and the advertising and capitalizing to become a real rival of Amazon and some of the others, the conglomerate kind of sphere? Also, it's all cash.
Looking to buy that deal in cash. Plans to finance the deal with cash and or debt. I've seen that headline just drop right now. Either way, it's very different to what we heard from Capital One and Discover a little bit earlier this morning.
But it's also coming from a point of strength. And this is the difference between the Capital One and Discover deal. Not as much strength. That is trying to become a stronger player. This is trying to dominate. And that, I think, is notable, because this is basically a company that is looking to really be competitive with the big tech players. This is one of the biggest hirers of tech staff, actually. So Walmart's playing a real interesting game here.
Completely different story over at Capital One and Discover Financial Services, a $35 billion all-stock deal. AMH, number one question for so many people looking at this deal this morning is whether the Biden administration will ultimately give it the green light to go ahead.
Well, the music in Washington, D.C. when it comes to these big mergers is that no. When you look at the DOJ and the FTC, Matt Schultz over at LendingTree had this to say, saying, given this recent challenges of Discover, will this be what Lisa's talking about, a white knight coming to help fix this troubled player? Or will the market view this as it means less competition on the board? Will the Biden administration look for that and then say this is void?
Discover right now up by, let's call it 15% in the pre-market. The broader market looks like this on the S&P 500, pulling back by, let's call it a third of 1%. Yields repriced higher again last week, this morning, just a touch lower, 427.53. Lisa, it wasn't about stronger output. Retail sales disappointed. This was about hot CPI and hot PPI. I would argue, I think Stuart Kaiser of Citi mentioned the same thing in his note yesterday evening, that we're pushing out rate cut expectations on the back of that for bad reasons, not good ones.
And Stuart Kaiser was saying, good news is still good news, guys.
Kinda.
Whispered
it.
But we're gonna think about this going forward, about maybe at some point good news becomes bad news if we're not talking about the good news actually being retail sales coming out. And I will just dovetail this into a little bit more color from the Walmart earnings, where they basically did reduce their forecast and talk about the softer, sort of more selective consumer. So this might be not just a one-off that has to do with seasonals, but a longer-term story. Does that play into the strength that people are betting on?
If we had the audio version of Stuart Kaiser's notes, which we don't, but if we did, the tone would be different yesterday, right? I think he probably would have used that voice.
I think so, given the fact that he was saying for now, right? Good news was good news, unabashedly. He would come on and say, just cut it out with this good news is bad news crap. But then he's basically coming out and saying, for now, maybe we have to see. And I think that's a shift.
That was not the optimal mix in the data last week. Let's say that for sure. Coming up on this program this hour, here's the lineup for you. Sam Stovall of CFRA, with the S&P coming off its first week of losses since early January. Joe Feldman of Talcyon, Walmart and Home Depot earnings. Amanda Linen of BlackRock as the Fed hones in on commercial real estate. We begin with our top story this hour. Hotter than expected economic data snapping 5 weeks of gains on the S&P 500. Sam Stovall of CFRA writing this. Market volatility has been consistent with the S&P 500's returns after eclipsing large round numbers. Short-term declines have typically occurred, but they have been fairly short in duration. Investors would be wise to view them as reasons to buy and not bail. Sam joins us now for more. Sam, get into that for us. Build it out for us a little bit more. Why buy here and not bail?
Hey, Jonathan, good morning. Well, I don't really think you should bail unless you have a crystal ball that says when we're going to be seeing the peak in prices and that the decline would end up being relatively shallow, because traditionally what we find is that the S&P advances another 2 months after recouping all that it lost in the prior bear market before stumbling by about 8%, but then advancing once again. And if you look at other historical indicators, such as the market being up in January in an election year, full year has been higher 100% of the time since World War II. All-time highs in January and February has increased the average price by almost 2 to 1 for the full year and increased the batting average to 88%. So there are several other indicators that basically say, okay, this market could end up being strong this year. But the timing is that, maybe we do end up with some sort of digestion of recent gains, but that would probably end up being a buying opportunity for the strength that I see occurring in the final quarter of this year.
Is a drop of 0.42% a buyable dip?
Of 0.42%.
That's the decline of last week, which is basically the first week in 6 that you saw declines, and the second week down in the past 16 weeks of declines. That's the kind of negativity that we're talking about in a market that seems to be going up. So how do you identify a dip that's even buyable?
Well, that's true, because when we did have that 0.42% decline, you recall the day after the S&P 500 set its 11th all-time high in this year-to-date period. So investors thought, even in the very short term ahead of earnings reports, that this was a buying opportunity. But I think that there will end up being a bit more of a digestion of gains in the period ahead. I really sort of see the market sort of undulating between maybe the 5,100 level, 4,800 level, really just giving investors time for the earnings to catch up to the multiples, et cetera, before we advance further once the Fed does finally cut interest rates, because I think that they are sticking to their slower to lower interest rate mantra.
Sam, there have been a lot of conflicting data points. Last week we got, as John was mentioning, weaker than expected retail sales, but harder than expected CPI and PPI, raising this question of the wrong kind of inflation. Today from Walmart, we get commentary about a more cautious consumer, with the CFO saying they're being choiceful and talking about how there's going to be a little bit more caution expressed in their shopping habits. Does this give you pause to something of a greater weakening than maybe people are recognizing?
No, I don't. I think it's management's job to manage expectations. This will end up being the 57th quarter out of the last 59 in which actual results have exceeded end-of-quarter estimates. We entered the quarter thinking we were going to see earnings up by about 2%. Now earnings are expected to be up by 5.3%. And consumer discretionary category is expected to show improvements not only for the fourth quarter of 23, all of 23, first quarter of 24, but also we're seeing improved outlooks for all of 2024. So what we're really seeing is management doing their job.
Sam, you've touched on the earnings mix. Let's go to that and talk about the contribution coming from the Magnificent Seven. How vulnerable is this equity market to just a bad earnings report from NVIDIA after the close tomorrow?
Well, I think there is vulnerability there, not only with NVIDIA, but also just tech in general. Historically, whenever we have been bumping up against that 30 multiple on forward 12-month earnings, basically tech itself has stalled. But the real question is, will we end up seeing an improvement in participation rates? Right now, whether you look to the 50-day, 200-day, or combination of both, we are now back above average for all of the sub-industries in the S&P 1500. So participation is there. 54% of the stocks in the S&P 500 are positive on a year-to-date basis. So we are seeing contribution, but the true leadership is coming from the Magnificent Seven, the Sensational Six, the Fabulous Five, whatever you want to call them.
The number's getting smaller and smaller, Sam. Sam, it's good to hear from you. Sam Stovall there of CFRA, looking ahead to NVIDIA earnings and a whole lot more after the close tomorrow. If things are improving elsewhere, if you can identify these pockets of improvement, Lisa, those voices are getting drowned out by monster gains again in stocks like NVIDIA.
The overwhelming one. I'm trying to think of
Seriously,
all of them.
sure.
Seriously, terrific too. I mean, but this is basically, you know, how much can you whittle it down to one name that can make or break an entire market? And I guess we're going to see that tomorrow.
That one name seemingly at the moment, for some at least, is NVIDIA. And those reports, as Lisa suggests, come after the close tomorrow afternoon. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Capital One has agreed to buy Discover Financial in a $35 billion all-stock deal that creates the largest U.S. credit card company by loan volume. The price represents a roughly 25% premium on Discover's last close. Capital One says the deal will help build a payment network that can, quote, compete with the largest payment companies. The deal is expected to be completed by the end of this year or next. It would be the biggest global deal of this year so far. Russia's war with Ukraine is nearing its third year. This morning, the Ukrainian Air Force says it shot down all 23 drones and missiles fired from Russia overnight. A regional governor says 3 people were hurt. Meanwhile, President Biden says he'd be willing to meet with House Speaker Mike Johnson to discuss stalled aid for Ukraine and Israel. Biden says the death of jailed opposition leader Alexei Navalny adds to the urgency of the moment. The U.S. has proposed a UN Security Council resolution warning against an Israeli assault on Rafah and calling for a temporary ceasefire, according to a copy of the draft text seen by Bloomberg. So far, the Biden admin has been reluctant to take steps against Israel, but frustration with Benjamin Netanyahu's government is growing. That's your Bloomberg brief. John.
Danny, thank you. More from Danny a little bit later this hour. Up next, the consumer showing signs of weakness.
You can certainly see that there is some stress on the low-end consumer. You're seeing delinquencies come up on credit cards. You're seeing auto loan delinquencies come up. There is stress in the low-end consumer, but right now the higher-end consumer is still consuming.
The latest on Home Depot and Walmart up next.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Stocks pulling back just a touch. We're down about 1/3 on the S&P 500. This from Andrew Hollenhorst of Citi just moments ago. Soft landings are unlikely precisely because inflation forces the Fed to hold policy rates higher for longer. That part of the story last week as yields repriced higher this morning, just a little lower on a 10-year 427.33. Under surveillance this morning, the consumer showing signs of weakness.
You can certainly see that there is some stress on the low-end consumer. You're seeing delinquencies come up on credit cards, you're seeing auto loan delinquencies come up. There is stress in the low-end consumer, but right now the higher-end consumer is still consuming, and so therefore you don't see that balance isn't there yet quite, but I think that there's some real stress under the hood of the system, and I think that's where you have some real tension going forward.
Here's the latest this morning. Shares of Home Depot falling today after reporting a fifth straight quarterly decline in revenue. The CEO calling 2023 the, quote, year of moderation. Meanwhile, Walmart offering softer guidance. The world's largest retailer saying consumers are being, quote, choiceful and expecting sales growth to slow for fiscal year 2025. Joe Foundman, Senior Research Analyst at Telsey Advisory Group, joins us now for more. Joe, let's start with Walmart, a question that we love to ask on this program. If they're doing well, is the country doing poorly? What's your read on that?
Yeah, I do think that, Walmart has been doing very, very well. They certainly seem like they won the holiday season, and the consumer has been trading down. I mean, we do continue to see that, and I think Walmart's strength reflects some of that. It doesn't mean it's all bad for the consumer out there. I do think that the consumer is choiceful, as Walmart said, and it has been able to spend where needed. We've seen unit sales, actually, of some of the discretionary categories were increasing during the quarter, even though food and essential goods were really the driver. But we did see some pretty good strength, and you're seeing continued traffic in positive territory at Walmart.
I remember the last earnings season where Walmart shocked us all by talking about outright deflation. And we said, oh my goodness, we're going to enter this deflationary spiral. And now they're saying, maybe not so much. What do you sort of see as their pricing power and their ability to look past some of the weakness that we saw last year that seems to have shifted, particularly in the goods sector?
Yeah, I think Walmart always tries to lead on price. We do pricing studies on a very regular basis, and Walmart is always the lowest price. So you're going to get the best value there for whatever it is you're shopping for. And I think that they're going to continue to do that. And I think what we're seeing this morning from Walmart, from Home Depot, and what we'll see over the next couple of weeks with earnings is 2024 is looking to be more of a year of normalization. And, the year starting on probably going to start somewhat soft and hopefully pick up a little bit as it progresses, as we start to normalize with inflation, deflation issues across different product categories, and then kind of get back towards a more normal split between essentials and discretionary goods.
Not to be existential, but what is normal? And I ask this at a time where Walmart is really trying to compete more directly with Amazon. Who is its biggest competitor right now? Is it the Targets and the Home Depots of the world, or is it Amazon?
I think Walmart would tell you they're competing with everybody on a daily basis. It's been very interesting to see them compete against Amazon, though. Walmart's e-commerce business was very strong during the quarter. They continue to execute really well. And, they're competing day to day, depending on the category, with really everybody out there, whether it's Target, even Home Depot, Amazon, and they're competing quite well. So we're really pleased with what we saw out of Walmart today. And I thought the guidance for 2024 was actually pretty solid as well.
It's buying Vizio. So to Lisa's point, there was a question earlier about whether Walmart is actually after trying to sell smart TVs or it's looking to learn more about consumer data. What do you think?
My guess is they're probably trying to get more of the data side of things, and they're trying to learn more about the customer, have better access to the customer data, and then be able to leverage that for some of their advertising business. Clearly, it'll be a big question on the earnings call this morning at 8 a.m. When they do speak with a Wall Street analyst. Certainly something we'd like to know more about. Obviously, selling Vizio TVs is a big part of it as well. I mean, I think Vizio is about 8% of the market share of TVs out there. So it's a good chunk of sales that they can drive business with.
Joe, can we turn to Home Depot and talk about the headwinds that you've been talking about for a while now facing that company? How much of their situation is out of their control?
Yeah, I think a good amount of the Home Depot issue, and Lowe's for that matter, maybe Floor & Decor, we'll see in a couple of nights, is out of their control. I mean, it really does relate to the fact that where the consumer's at. The consumers did a lot of spending on the home during the pandemic. We're coming out of that. They're making choices where to